Welcome to the European Market Open. A minute to go until the start of cash equity trading. I'm Tom McKenzie in London. These are the headlines. Technically speaking, the US shrinks for the second straight quarter as raging inflation undercuts consumer spending. But Janet Yellen insists the country is not in a recession. Prime time, Amazon surges post-market after giving a bullish revenue forecast and posting sales that beat estimates. Apple also climbs on the back of iPhone demand. Plus, banking on it, Standard Chartered, NatWest and BNP cheer investors as earnings beat the street. We're going to watch those shares at the open. Let's check in then on the futures, pointing to some further upside on the back of these pretty solid earnings that are coming through, and then the expectations that maybe weaker growth in the US is going to lead it to a pause when it comes to the Fed action. Futures pointing up 0.7%. Here's how things are going to open then as we weigh up the economic data that's been coming through from France as well. It was a beat on terms of the GDP, but CPI, that inflation print coming in higher for France. So just a reminder then of the conundrum for the ECB. Does it bake in another 50 basis points more firmly for the European Central Bank, of course, as they weigh up the prospects of further reductions in gas, but clearly a reminder that inflation remains very, very high across the Eurozone. Gains of 0.3% across the FTSE 100. In terms of basic resources, you may see a drag there on the back of the fact that iron ore has come off. No additional fiscal response from China. That was the line out of the Politburo. The Spanish IBEX currently gaining 0.7%. Over in France, very solid picture there just in the first few seconds, up 74 points, again of more than 1%. We'll be digging through the earnings, particularly when it comes to Renault. Spanish IBEX, as I said, up 63 points. The banking sector, again, as we said in the headlines, the likes of BNP Paribas, and of course that's going to play into the CAC 40, and NatWest coming out with stronger than expected results. The CEO of NatWest saying she sees demand and the picture holding up even as we kind of weigh up this potentially recessionary environment here in the UK. The Bank of England expects to hike rates again next week for the 6th straight time. That is going to prove a benefit for those net interest margins for NatWest and other players. The futures in the NASDAQ, when it comes to the NASDAQ, of course, tech heavy, gaining 1.4%. Apple and Amazon really coming out strong. E-commerce held up, but it was the cloud services part of the business. And the picture going forward, the executives painting a pretty positive one. They are navigating this tougher environment quite well, it seems. Apple also coming in with a beat in terms of the demand for those iPhones as they navigate the challenges in markets like China. The Japanese yen, currently 132, so you see some strength there for the Japanese, currently 1.6%. Pretty solid. Mark Cudmore is going to break that down for us shortly. Brent crude, we're looking ahead to OPEC Plus and that decision next week. Will they ramp up supplies after that charm offensive by the US president over in Saudi Arabia? Currently $107 a barrel, up 0.7%. And we're talking about iron ore futures, of course. The iron ore numbers and pricing coming up again, or off, I should say, after a number of days where you've seen elevated pricing on the back of the potentially forecast stronger demand out of China. That was really dispelled by the Politburo, and you're seeing prices soften by 3.4%. But let's get back to that Japanese yen. Very curious, because Mark Cudmore has been watching this really since the start of the year in terms of the transitions and how things are playing out across the Japanese currency with that focus on the BOJ. Mark, what do you make of the upside that we've seen in the yen then?
Yes, Tom, dollar yen is collapsing today. Around midday today, my inboxes and my IB chats, my WhatsApp chats suddenly started blowing up with what's going on with the yen. It is really sliding. It's having the fastest 2 or 3 day fall since the March 2020 in the height of the pandemic panic. That's back there in the chart. And this is a 5-year chart. And that's to show, look, dollar yen's collapsing. But look how irrelevant it is compared to the climb of the last 18 months, which is really still up more than 25% over those 18 months. It's still up more than 15% since the end of February alone. And I think this is the point. This is about summer markets. This is about the fact that the first half of this year, up until mid-June, we really had one-way markets for most assets. It was just a simple trading environment. We were trading those trends. It was a great macro environment. Suddenly we've hit the summer. Suddenly we're getting a bit of a consolidation. We're seeing that in treasury markets. We're also seeing it in dollar yen. What does that mean? Well, it means it can pull back further. The fundamental story, though, remains for this pair to head higher again later on this year, maybe the fourth quarter. Ultimately, the BOJ is maintaining extraordinarily easy policy when the rest of the world is hiking rates aggressively. And I think that theme will come back in vogue. I think the pair can go higher. But for the next few weeks, sure. You know, will it go to 130 next? Sure, it could be there in a day or two. Will it go down to 125? Probably not that far, but it wouldn't completely shock me.
Okay, so it could be a relatively short-lived bounce that we're seeing for the Japanese yen, given that historical context. Bloomberg's MLive managing editor, Mark Cudmore, thank you very much indeed. Now, US equities rallied to a 7-week high, led by defensive groups. That's as recession fears grow after US GDP contracted for a second quarter. Let's get into the key market drivers then with Virginie Maisonneuve, Global Equity Chief Investment Officer at Allianz Global Investors. Virginie, thank you for coming onto the show. What a great day to have you on to pass all of these earnings and, of course, what we've been seeing in terms of the growth picture out of the US and indeed here in Europe as well. Does this equity rally have legs, or is this a bear market bounce that we're seeing?
Well, I'd like to call it a relief rally. And I think point where we are is an inflection point on this narrow path, if you want, of normalization of monetary policy post-COVID, and this unknown on how fast we get there. We have to remember it's the fastest tightening we've had since the Second World War. Now, the relief rally is based on the fact that companies have actually given us some quite good results. So, and the fact that people expect, in light of expected contraction in the economy, that rate increases are either going to slow down or at least be less strong or less large, if you want, in terms of magnitude. That's the reason for the relief rally.
And Virginie, do you and the team at Allianz, do you drink the Kool-Aid on that theme that you're going to get a pullback from the Fed?
Well, clearly, monetary policy tightening is a very delicate exercise. The one thing that we have to remember is the central banks, in a way, fell behind their mandates, if you want, at the beginning of the cycle. And you understand why. It was quite confusing, COVID, monetary policy, fiscal, et cetera, et cetera. I think at this point in time, the big fear for central banks will be to stop too early. So I think we will probably, if there's any policy mistake to be made here, would be to tighten a little bit too late, in order not to be in a situation where if you stop too early, inflation comes back, and then you have to tighten in an environment where the economies are in a very tough spots, potentially. So I think we'll go longer than what the market is currently estimating.
And Jay Powell was at pains really to point out the dot plots and 3.4%, 3.8% next year. When it comes to the data, Virginie, we're getting the data out of Europe today when it comes to France, GDP, CPI as well, and then looking ahead to the US, the PCE deflator amongst a bunch of other data coming out of the US. Is it the growth data that's going to steer these markets, or the inflationary picture that's going to be more of a propellant?
I think it's both. I think what we're going to have, as you know, inflation tends to be sticky. So if you look at a chart that I've looked at for many years, M2 in the US, which is monetary supply growth, you'll see a very sharp deceleration with a peak that was in February last year. Generally, when you have such a large fall in M2, you have a strong deceleration of growth or demand destruction. We're in that phase. So if you look at PMIs, if you look at business confidence, if you look at inventories, for example, all of this point to a very sharp deceleration. Now, that will happen, in my view, before the inflation picture really comes back. And there, what we have to watch is really core inflation, goods inflation versus service inflation. Service inflation will probably be more sticky, but if you look at the inventory movements that we're seeing, goods inflation could come back much earlier. So I think it's going to be a question of timing, and this is really, really important for companies, how the dynamics of those two elements play out. You could have a period during which inflation continues to be sticky, growth decelerates very fast, and there it's going to be the tight game for companies.
Okay, so the importance of looking at the divergence then between inflation when it comes to durable goods and services. And Virginie, very pleased to say we're going to keep with you and get you back in the next couple of minutes. We're going to get your take certainly on the earnings picture and break that down, and also get your views on how to position within these markets then. Virginie Maisonneuve, Global Equity Chief Investment Officer at Allianz Global Investors, stays with us. Coming up, we've got plenty more earnings conversations on the way. The CEOs of FDJ, EDP, the renewable company, Swiss Re, the reinsurer, L'Oréal and Renault all join us this morning. Stay with us. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We had a huge challenge to mitigate the cost inflation.
We certainly are seeing continued inflationary pressures on our cost of goods.
In the first half of this year, we actually have positive net pricing, so being able to cope with inflation.
We are very surgical and careful on how much pricing we take and where.
We certainly see peak inflation coming sometime in the second half. We're not there yet.
We have been suffering from a significant cost inflation coming mostly from energy as a consequence of the Ukraine war.
Where we are seeing superinflation is through the aircraft component supply chain.
We actually sell more than half of our products into China, and China does not have inflation.
If inflation continues to be here, of course it will be reflected also in pay.
Okay, some of the CEOs we've spoken to this earnings season, of course, on the impact of inflation. Let's check in on some of the individual corporates then, the movers, and all of these are earnings stories. Hermes, as our reporter was telling us before the break, or before this hour, has performed pretty well in terms of the earnings picture there. Gaining 8% on the back of a beat for Hermes. NatWest, we were speaking to the CEO, they continue to see a pretty robust picture in the months ahead for this banking group, despite concerns about the UK potentially heading into a recession. Gains there, as you can see, of 18 points, or 8% after a beat for NatWest. AstraZeneca, it was also a beat, but you're seeing some downside pressure there on those shares, down 2%. Of course, they are weighing up what is happening in terms of the COVID medicines and that pipeline of drugs as they continue to spend very heavily on R&D. That is the UK-listed drug maker AstraZeneca, down 2%. Still with us is Virginie Maisonneuve, Global Equity Chief Investment Officer at Allianz Global Investors. Virginie, have you been surprised by the robustness overall of the earnings picture? And are the forecasts by these companies, are they overly optimistic? Do they look like they're going to be tested by this economic environment?
So yes and no to all your questions. I think on one hand, what the results are showing is for the companies who are very strong, good management, good vision, really fast reaction, agile. This quarter has been a good quarter. I think the guidance is interesting because, as we were discussing, the next 3 to 6 months are really going to be about this potential gap, or the time dynamics, if you want, between how inflation is going to peak and the impact of existing inventories with the decline in demand. And of course, there we're talking about general factors. So each company is going to have very different demand trends, luxury versus non-luxury, retail, online, technology, etc. So you have to be, it's really detailed. It's really company by company. It's about quality, management, resilience, governance. All of this is more than ever super important.
What do you do with cyclicals in this environment? Do you steer clear, given the economic downside that we're looking at?
It depends. So what do you mean by cyclicals? If you include industrials, I like some of the industrials. I like industrials who have long-term support. So for example, as we know, energy security is very, very important. And given the crisis, even more at the top of everybody's mind. So renewable build-out, infrastructure, anything that is linked to that chain, if you want. Automation, I still like, AI, cybersecurity, all of this are themes that are going to carry beyond this. And we just have to go through the next 6 months. So on any weakness, I think those are names or sectors, subsectors that you need to add to.
And what do you do, Virginie, with mega cap tech? I mean, I think it's fascinating that you're getting a big divergence among some of these players now. Amazon, for example, versus Meta. Very different spaces, of course, but bunched together previously, historically. What do you do? Do you like mega cap tech, and how are you being selective?
And again, you know, it's about differentiation now. It's about specific vision and governance. And it's also in the tech space about capital discipline. And the fact that investors really want to see profits. They're looking for more solidity, if you want, versus when cost of capital was basically zero and where people were focusing on revenue growth. So I think you're really having the distinction. This is a big theme, distinction between quality management, quality companies, and the other sector, if you want, or the rest of the market.
Virginie, before we let you go, what are the regional divergences that you expect to see playing out as we weigh up the central bank action and, again, that economic picture, whether it's China, Europe, or the US? How does that play out in the months ahead?
Yeah, so again, it's region, it's not companies. We have to remember within, say, Europe, a company can be exposed globally and therefore be more isolated from the, challenges in Europe. But over the next year, given the energy issues, Europe is really at a disadvantage versus the US. I think the US will be a strong leader of growth, even in a very low growth environment. I think Asia and China is very interesting because, as we've seen overnight, some of the news disappointed the market in terms of not bringing a big package. But why bring a big package when you still have those COVID, lockdowns? So I think Europe is the pressure point. The energy crisis is still there. The rationing is still there, and we really have to navigate that carefully.
Okay, the pressure point still in Europe. Virginie Maisonneuve, thank you, as ever, for those insights. Very valuable. Global Equity Chief Investment Officer at Allianz Global. Okay, coming up, feeling lucky, the operator of France's national lottery sees EBITDA rise 18% year on year. We're going to speak to the FDJ CEO, Stéphane Pallez. That is next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open. We are 20 minutes into the European trading day. You're seeing gains of 0.8% in the US, futures pointing to upside of 0.8 on the S&P, 1.5% on the Nasdaq futures after the very strong picture out of Apple and Amazon. The CAC 40 over in France gaining 1.6%. Part of the factor will be La Française des Jeux playing into that picture, also known as FDJ, is the operator of France's national lottery games. It's reported first half EBITDA of 308 million euros. That's an almost 20% year-on-year gain. The CEO says, given the deterioration in the global economic environment, the group remains cautious but confident in its outlook. The stock now up almost 3%. Stéphane Pallez, the CEO, joins us now. Stéphane, you talk about the caution and the optimism. Let's start with the optimism. Congratulations on these results. What gives you that optimism, particularly in an environment where Goldman Sachs tells us the base case for growth in Europe will be a recession?
Well, it's because, of course, we are confident because we have demonstrated our ability to be resilient in different contexts over actually a long historical period. We've also demonstrated this not in the first months of COVID, but quite quickly during the COVID crisis. So we are confident in the capacity of the company to remain resilient in those contexts. We had, as you say, very good results in terms of growth. Our revenue are up 12%. Our EBITDA is up 18%. Our growth was strong on both channels, on our point of sales, on online. Our sports activity was a little weaker, but it's quite natural since the big event in football is at the end of the second semester. So we are, of course, ready for this. So all in all, again, maybe the economic context is definitely becoming more stringent. Inflation is higher, although France is, as you know, has a lower inflation rate than most European countries today. But we think that this is still puts us in a good position to reach our guidance for this year, which is 5% growth at the end of the year and EBITDA margin 23.5%. Yes. So we remain confident.
So revenue growth, the target is for 5% for 2022. You're not changing that?
No, absolutely not. We could. Some people have asked us why we don't raise our guidance in terms of revenues. We have answered that because probably in the first half there is, in terms of base comparison, an impact due to the fact that the first half of 2021 was a little bit low in our point of sales because not all our point of sales were open in 2021. So there is a base impact that does explain probably 2/3 of the exceptional growth we had in revenues. And the second reason is that we want to be, I would say, a little bit cautious given the uncertainties that we have in the environment, even though, again, Française des Jeux has demonstrated its ability to navigate in different economic contexts with good revenues and good profitability.
Can you just give us a little bit more granular detail on the inflationary impact across your consumers that you're seeing? Is it holding people back from playing or from placing on bigger bets, or is it indeed making people a little bit more risk sensitive? In fact, are they more risk averse, or do they want to be placing bets because their household income is being squeezed?
Well, if I look at the data we collected for the last 25 years, actually we can say that the company is acyclical. So we are not reacting either to stronger growth, either to a recession. Our growth is mostly driven by our own marketing, innovation, and development. However, of course, one has to be cautious, so we're looking quite carefully at what's happening right now. Right now, we don't see any signs of behavior of our customer that would be related to the context. In luxury, I think it's quite explainable by the fact that we have 25 million clients that do play reasonable sums. So they're basically quite regular in the way, and we have this what we call the extensive model. In sports betting, it might be a little more sensitive to the context, but at this point we don't see any signs, basically.
Stéphane, we're running short of time. Just very briefly before we let you go, the government owns about 20% stake in the company. Any pressure from government officials to give back some of these profits?
No, we have the state is a good shareholder. Is I think aligned with all the shareholders. Is expecting recurrent nice profit with a distribution that is between 80% and 90% of our net results. So everything is I think is fine and well on this side.
Stéphane Pallez, thank you very much indeed. The CEO of FDJ, not facing any pressure from the French government, a major shareholder, of course, at this point. The shares are up 3%. It was a beat for the French lottery company. Coming up, as the energy crisis continues to grip Europe, we speak to the CEO of Portuguese energy company EDP. It has reported an 11% year-on-year fall in net income for the first half. This is Bloomberg.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Happy Friday, welcome back to The Open. We are 30 minutes into your European trading day, and here are your top stories. Technically speaking, yes, the US shrinks for the 2nd straight quarter as raging inflation undercuts consumer spending. Janet Yellen, the Treasury Secretary, insists the country is not in a recession. Prime time, Amazon surges post-market after giving a bullish revenue forecast and posting sales that beat estimates. Apple, meanwhile, climbing on the back of solid iPhone demand. Plus, banking on it, Standard Chartered, NatWest and BNP Paribas cheer investors as earnings beat the streets. Shares in the lenders surge. Let's check in then on these markets. It is very much the close, coming to the close of course, of a monster week for those earnings. And the picture so far this morning has been relatively positive in terms of the numbers that have been coming through, as we mentioned, particularly within the banking sector. And we continue to speak to these CEOs and executives to pass their views on inflation and recessionary risks. Again, as some investors, particularly stateside, weigh that softer GDP data and that weaker outlook for growth and take the bet, take the punt that maybe the Fed is going to have to cool its rate hikes. Maybe there's a pivot in the works, even as some economists say too early, too soon. The Stoxx Europe 600 gains of 0.8%. Over in Germany, the DAX adding 97 points, 98 points, up 0.7%. Here in the UK, the FTSE 100 up 0.4%. Let's break it down and see how the sectors are performing then as we weigh up these earnings and that debate around growth. Worth pointing out as well that CPI out of France, just a reminder, coming in higher than expected. Just that inflationary picture remains elevated. But the GDP picture out of France, yes, it's backward looking, of course, but that came in as a pretty solid beat. So consumer, travel and leisure, banks, no big surprise there, all leading the pack. Autos as well. We're going to be speaking to executives from Renault as well in the next couple of hours. At the bottom of the list, just one sector. It is that traditional safe haven of healthcare. AstraZeneca, a bit of a lag, even though they came in with top-line results that beat just down 0.1%, just a smidge across that sector. We look ahead, of course, to the US, where the NASDAQ futures are pointing to very solid gains, again, on the back of those very decent earnings, particularly out of Amazon. Let's get back to the particularities then of the energy sector and one earnings number that really helps us dive into the renewables picture and that demand for renewables amid this gas crisis in Europe. EDP, it has reported, it's a Portuguese company, it's reported an 11% year-on-year fall in net income for the first half, but EBITDA rose 18%. The company says results were marked by, quote, the positive performance of renewables and networks in Brazil. Joining us now is Miguel Stilwell, EDP CEO. Miguel, the market's then applauding these earnings. Shares were up the last time I looked, about 2%. Where does that leave you as you look to the quarters ahead? What is the momentum and the picture looking like? How much clarity do you have?
Hi, Tom.
So we had a relatively bad first quarter, but then a very strong second quarter. And so I think what we're seeing is this increase in EBITDA of around 20% that we had over the first half. We expect that the following quarters will also be quite strong. And so for the full year guidance, what we've said is we would be above last year's net profit and EBITDA. So I say that generally positive for the rest of the year, but very hard hit by the worst drought in 90 years in Iberia. So that obviously is something which marked quite heavily the year. What has been very strong has been renewables. So our listed subsidiary, EDP Renewables, which had an increase in net profit of 87%. And obviously Brazil, as you mentioned as well.
And you also announced the acquisition of Kronos over in Germany. Talk to us about the rationale for that acquisition and what you're thinking about in terms of other potential bolt-ons to the business.
So as you know, we have a very strong presence in renewable space. In general, we're in 28 different countries, over 14 gigawatts of renewable capacity globally, both mostly in wind, but also in solar. Very strong presence in the US. In Europe, it was important for us to be in all of the major markets. And certainly we see Germany as having a huge potential for growth going forward, particularly now given all of the energy crisis and this pivot away from Russian gas. So really this is a move that we make because I think it complements very much our existing portfolio. We are already obviously in Portugal, Spain, Italy, France, Greece, Poland. Germany, I think, was the piece that was missing. We found a great opportunity. We bought 70%. We will be partnering with the founders to continue to grow that company over the next coming years.
Okay. So you've added Germany to the list. You operate in, 28 markets, at least 4 different continents. Other regions that you're eyeing up, Miguel, that you want to be adding to the list?
I think we're pretty comfortable with the number of countries we're in. It already represents more than 75% of the global estimated growth in renewables. So I'd say that we don't have any other geography that we're looking at the moment. I think we have a lot to do in the geographies that we are in. We recently went into Asia Pacific, based out of Singapore, but also with a presence in Japan and in China, Taiwan, South Korea, Vietnam. So I think in that part of the world, we also have a strong presence. It's obviously growing very strongly as well over the next coming years. So I think that's also a good area to watch.
Okay, Miguel, in terms of targets, you previously set yourself a target of doubling solar and wind energy capacity, installed capacity to 25 gigawatts by 2025. Do you exceed that at this point, do you think?
Well, I think things are certainly looking very positive. So last year we had installed a record number of megawatts, 2.6 gigawatts, so 2,600 megawatts. We have a record number of megawatts under construction, 3,200. And next year we're expecting to install over 4,000 megawatts. So I think we're on the right path to certainly achieving that target. We already have a lot of projects secured that we will be initiating construction over the next coming months and years. So I'd say, we are confident that we will be delivering on the business plan, and we continue to look at additional opportunities to potentially even grow beyond that. But for now, we're just focused on delivering the plan.
Okay, and as we weigh up the prospects, the potential reaction from Vladimir Putin over in Moscow, around potentially cutting off gas supplies entirely to Europe, what at this point is the impact of this gas crisis on your business? You obviously pull in gas yourself, but then you are, of course, providing that utility as well. How is it impacting the business?
I'd say it's a terrible situation, not just because of, in general, for the European economy, I think, not just because of the gas prices, but just because of the fact there may not even be gas for some of the economies, and there is already rationing and curtailment. For us, as a business, it's actually a great opportunity. We have a huge potential. We have a huge presence in renewables, and we have a potential growth in renewables. As you mentioned, we are estimating to invest 24 billion euros over the next 5 years in the renewable space. And clearly, when we look at renewables now, it is not only much, much cheaper than the alternatives of gas or coal, but it's also much more reliable because it's an endogenous energy source. So it means that we would not be dependent on importing, whether it's gas or coal or other sources of energy from outside of Europe. So I think renewables at the moment, it's not just a play on decarbonization, which is obviously important. It's also just much more affordable. Just to give you 2 numbers, I mean, renewables, you can now build wind or solar and get energy at let's say 40 euros per megawatt hour. The wholesale price at the moment in the market with using gas is maybe 300, 400 euros per megawatt hour in some European countries. So we're talking an order of magnitude cheaper. So the faster we can build renewables, the more renewables we can put in, the faster we can also bring energy prices down. So for us as a company, it's a really tremendous opportunity.
And of course, the importance of doing just that was really illustrated by the scorching heat that we all felt across Europe in the last few weeks. Talk to us a little bit about costs, Miguel, before we let you go. The cost structure of the business, particularly costs around turbines. How do you see that evolving in the months ahead?
So there has been inflation both on turbines and also on solar panels. I think that was very evident since the end of last year, to be honest. So the second half of last year, we're already feeling that increase in prices. That is feeding through into higher energy prices because obviously that, when we are pricing our projects, new projects, we are pricing it already with that higher capex numbers. So that's feeding through. But I think the important thing to note is that the increase in costs that we have seen translates maybe into a 10, 15% increase in the cost of energy of the PPAs. So as I was mentioning to you, maybe it's going from 40 euros per megawatt hour to 45 euros per megawatt hour. That's still much, much cheaper than the 300 or 400 euros per megawatt hour that you're seeing in terms of the gas or the coal energy. Okay. So even with that inflation, which is feeding through, renewables ends up still being much more competitive than the alternatives.
Okay, the competitive advantage now of renewables. Miguel Stilwell, thank you very much indeed. EDP CEO. On the back of those results, the stock currently up 1.7%. Coming up, we're going to speak to the CEO of reinsurer Swiss Re as market volatility and the war in Ukraine hits the bottom line. That interview is next. This is Bloomberg.
Back in 1997, I was interested in the following question, which is there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long skinny necks. So Apatosaurus is an example. They also had really long skinny tails. So I made a computer model that showed that in fact the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. And that crack is a sonic boom. Yeah. I think the way they got a date was to impress the females by making loud booms.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the Open. We are 43 minutes into your European trading day this Friday. Gains of 0.7% across European equities. In the US, NASDAQ futures pointing to upside of 1.3%, digesting those solid earnings out of Amazon and Apple. Sticking with the earnings picture then, Swiss Re saw net income for the first half of 2022. It was a whopping 85% lower than last year. The reinsurer blamed market volatility, COVID, and the Ukraine war for the profit plunge. It made $157 million this year, whereas it made more than $1 billion in the same period of 2021. Christian Mumenthaler is the Swiss Re CEO, joins us now. Christian, good morning. Thank you for joining us. Just give us your top line then on these results and your views and the outlook for the second half, particularly given the ecological damage that we've seen across Europe with the droughts and potentially hurricane season as well in the second part of this year.
Yeah, thank you, Tom. Good to be back. So we were very happy in the second quarter to turn back to profit because obviously the events this year have been very tough. If you compare to the last year, the biggest difference, about 2/3, is financial markets as a consequence of all the turmoil we have and the war in the Ukraine. And about 1/3 is the war itself and some higher than expected natural catastrophes. So it's a big change from last year, but second quarter was much better. We had much lower COVID losses. So finally, it seems we're entering an endemic stage. At least that's the hope. And the figures, we had the best quarter since the start of the pandemic. And then overall, the capital situation of the group is extremely strong. We're above our target range. So these are tough times. There's no question, one of the most challenging environments, but that's the kind of environment we're here for. We're here for our clients. In terms of the second half of the year, very hard to speculate. So,
No, I'll let you answer that because that's important.
So it's very hard. We don't have a crystal ball for the second half of the year. Obviously, the volatility remains very high in financial markets. It very much depends on how they develop because we have a US GAAP standard, and in that standard, every mark-to-market movement on the equities go through the P&L, which is part of what we see right now. So if there's a recovery, of course, it's a totally different results than if there isn't. And then on the natural catastrophe side, we have a budget of 1.9 billion of expected claims, and we're at 900 million at this stage. So it very much depends on how the rest of the year will play out.
You touched on the war in Ukraine. What are the knock-on effects of that conflict for the broader insurance industry?
At this stage, by far, is the financial markets impact. Of course, it's hard to dissect how much is because of that, but clearly it has a huge impact on financial markets. And when you're a company like us with about $100 billion of assets, it has a huge consequence on the asset side primarily. On the liability side, it's hard to gauge. We still estimate it's going to be about like a medium-sized natural catastrophe event, which means about 10 to 20 billion of US dollars of loss, probably more to the lower end at this stage. But it very much depends of how long the war will last. As the longer it lasts, the more damage there will be.
You're going to be raising prices. I just want to get some sense of how far you think you can push prices up, how much stomach there is from your clients and your customers to those higher prices in this inflationary environment. How much room do you have?
Well, it's clear. It's like for everybody, the cost of goods sold is going up. So the CPI, wage inflation, medical claims inflation, all of that plays a role. Or spare parts in car, you can see it clearly have an effect on the claims line, and that needs to be costed in. So the price rise have actually accelerated. If I take the July renewal, we have 12% price rise, which is very significant for a book of our size. But we also booked 12% higher loss costs because we know there's inflation, we know there's continued climate change, etc. So it's just a must, right? There's no choice. Like everybody else, the cost of goods sold is going up.
What else are you in the business doing? What are your colleagues doing at Swiss Re to prepare for a potential recession? Are you comfortable with the cost structure? Are you having to work through areas to reduce those costs within the business?
Yeah, usually the positioning, what is really important is always to have a very strong capital base, which is a given. We're above our range, actually, of what we need to have. The second thing to do is always to look at your strategic asset allocation. So we have positioned it for a recessionary environment. We expect a recession in Europe and the US in particular. I think Asia will fare better. And then also on the underwriting portfolio, you need to take some measures. So this is more around inflation. So there's some lines of business we write less of as we renew the business. And finally, cost is always a topic. So over the last 10 years, our cost line has increased by about 1% per annum, and the top line has grown by 6% per annum. So this is 1% doesn't come naturally. You need to work on it every year.
We started by talking about the climate crisis, by talking about the effects of very, very high temperatures, record high temperatures here in Europe. Just give us a sense of how climate challenges are working their way in to your policies, the effects, the various different implications of what we're seeing, whether it's flooding or droughts or storms.
Yeah, first of all, of course, we have about 30 scientists who do nothing than that, right? To study the atmospheric and create the models. And climate change is for us a clear fact. There's the scientific consensus around, in particular, the perils like flood, drought, fire, etc. So we have constantly adapted the models that we have with which we price the risk. So that's part of the reason why the risk becomes much more expensive. And then overall, we're part of the companies who have declared that we're going to be net zero by 2050. I mean, a lot of people are following us now. There's a lot of other people who have declared these goals. And that means we need to accompany the whole economy, basically, because the whole economy is part of our clients or clients of our clients onto that path to net zero. And we do that through a mixture of encouraging people. We're investors. We have 100 billion of assets. So we as investors, we encourage all the companies, in particular in the hard-to-abate sector, to go also on a net zero 2050 path, and by excluding some of the worst offenders as another measure. So, for example, the International Energy Agency said that we don't need new oil fields if we want to make sure we keep on track for the 2050 net zero, and so we're not insuring new oil fields.
Okay, when it comes, just before we let you go, when it comes to return on investment, this time last year you saw an upside of about 3.2%, this time 1.2%. When do you get back to the kind of levels in terms of ROI that you saw last year?
Well, a lot of that is basically this mark-to-market movement on the equity portfolio in the first half year. The underlying, earnings you have, the recurring revenue you have, actually goes up. So to give you just two numbers, very interesting, the reinvestment yield. So when we got fresh cash last year, we invested, the average was 0.9%. That's as low as it is. By Q2 now, it's 3.1%. So a huge difference. And so the portfolio has a certain duration. So as it gets rotated through, as we get fresh premium and pay claims, this recurring income is going to rise more and more.
Okay, so benefiting from that higher yield environment as well. Christian Mumenthaler from Swiss Re, the CEO, of course, walking us through these earnings, how it positions the reinsurer in the months ahead. Thank you very much indeed. Coming up with Investors on Edge about an economic slowdown. Apple, well, it offers some good enough news at least to calm those fears. Meanwhile, Amazon soars after hours on a very strong third quarter revenue outlook. We're going to dig into those results, get the context next. This is Bloomberg.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Welcome back to the Open. We are 53, almost 54 minutes into the European trading day this Friday. Gains of 0.7% across the benchmark here in Europe. In the US, the S&P E-minis are up 0.6%. The futures, NASDAQ futures up 1.3%. And a lot of that, of course, is down to the earnings of Apple and Amazon. And now we get the detail on those big tech earnings. Amazon shares jumped in after hours trading after it posted pretty solid numbers, particularly around the cloud business. Apple also coming through with a beat. iPhone sales coming in higher than some analysts had expected. Narrowly top the estimates out of Apple for the quarter. Joining us now is Matt Bloxham, who covers all things media and, in particular for us this morning, technology for Bloomberg Intelligence. Let's start then with Amazon. And building up to this, we've been looking at Walmart and the sogginess around their results, their concern about the health of the consumer. Amazon is not seeing this. What is going on right? What's going right for Amazon that's going wrong for Walmart then?
Yeah, well, I mean, I guess Amazon's e-commerce platform is so broad. You can get anything, whether it's cheap or, branded, unbranded, whatever. And I think that, the diversity that they've got, the investments they've made in same-day shipping, it's just still seen as a great place to do your shopping. And I guess the strength of the platform is reflecting the fact they've been able to push prices up for Prime. So I think the fact that they talked about a good outlook for revenue growth in the next quarter and that they're not seeing customers slow down on their spending was encouraging, and then crucially that they're managing costs. Fulfillment costs were a bit lower than expected this quarter, and a clear message from the CEO that they'll be keeping a lid on costs going forward. So some opportunity there for margin expansion relative.
Because that was the concern. It was going to spiral out of control after they built out all that space and added all those employees during the pandemic, but they're now pulling that back in.
That's right, yeah, and I think the CEOs listened to that message from shareholders, and they're taking action, and that action is coming into effect quite nicely.
And AWS, I mean, they're still the market leader here.
Absolutely, I think something like 35% or so market share globally, enormous business, still growing over 30% year on year, and it's a huge source of profit for them. So without that, this would be looking like a very different business profitability. So yeah, really important that's still growing.
And briefly, Apple.
Yeah, Apple, the iPhone resilience was the big story there. Some weakness in Mac sales, but that's expected to catch up next quarter. And again, reassuring commentary from Tim Cook about the outlook for revenue next quarter. So yeah, relief there, I think, in terms of limited headwinds in terms of consumer demand for their products.
Okay, the smart analysis once again from Matt Bloxham, of course, of Bloomberg Intelligence on those earnings out of Apple and Amazon, and certainly they are powering the NASDAQ futures, gaining 1.2%, I should say. 0.6% is the upside you're seeing in the S&P E-minis, those futures. Here in Europe, you're looking at gains of 0.7%. The gains particularly pronounced over in France. The CAC 40 is up 1.3%. The FTSE MIB in Italy gaining 1.2%. Here in the UK, you're up by 21 points, 7,366. Strong earnings. Stay with us. The European Market Open Surveillance Early Edition is up next. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's equally clear that this is a thriving, entrepreneurial, and dynamic economy.
We want to be the first Europe-based among the global Tier 1 CIBs with an international reach.
We are optimistic about growth. I mean, we're very aware of the challenges that our people are facing.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in for Francine Lacqua in London. Here is what's coming up in today's programme. Technically speaking, the US shrinks for the second straight quarter as raging inflation undercuts consumer spending. But Janet Yellen insists the country is not in a recession. Prime time. Amazon surges post-market after giving a bullish revenue forecast and posting sales that beat estimates. Apple also climbs on the back of iPhone demand. Plus, banking on IT. Standard Chartered, NatWest and BNP cheer investors as earnings beat the street. Shares in the lenders surge. Welcome to the program, everybody. This is Bloomberg Surveillance Early Edition. Let us get to some of the data that we have coming out of the Eurozone right now, and we'll get to the Italian GDP figure. The preliminary second quarter GDP number rising by 1% quarter on quarter. That is against an estimate of an increase of 0.3%. So that number coming in well above estimates, and that really picks up on a trend. That's what we've seen coming through so far from France and especially from Spain. The message is that the economies have been running more strongly than had been expected, but big questions, of course, remain ahead. Tourism acting as a boost, it seems, in the short term. We've also had inflation data hitting this morning, and we've seen record inflation coming through in France and in Spain. Let us go to Germany then. We've got German GDP numbers coming through as well. Germany preliminary second quarter GDP unchanged quarter on quarter. The estimate was for an increase of 0.1%. So a different story coming out of Germany. Elsewhere in Europe, we're seeing these economies kicking at a stronger pace than we had anticipated. So beating estimates. So we saw that out of France, out of Spain and Italy. But in Germany, we see no growth, unchanged quarter on quarter for the GDP number for the second quarter. The estimate was for just an eking out of 0.1%. So let's not make too much of a slight miss, but it is showing a demonstrably different message, I suppose, to the other parts of Europe, at least versus estimates. So that's what we have on the growth story right now. Let's get to the broader markets and where we are on the broader market narrative right now. Stocks in Europe doing pretty well, actually. Is this all about expectations around the Fed? Are they well placed? Are they misplaced? A conversation we will no doubt have as we go through this morning. We do see the NASDAQ futures pretty strong this morning, up by 1.3%. And I mentioned that we had some strength in the Amazon story, certainly strength there. That stock up by 13% after hours. And we also have strength in Apple as well. So that's pushing up NASDAQ futures. Euro is up by 0.4%. So some of those data beats, you know, maybe that's part of it. But also we're seeing generally in a risk-on environment, weakness in the dollar, and that's pushing money into the euro and into the pound. Brent crude is up by 1.7%, 108 now the handle. We had been talking about how oil prices had retreated so much from recent highs, and now they seem to be creeping up again day after day. We are working our way towards an OPEC meeting that takes place tomorrow. Let us just give you a little summary of where we are across Europe on the Europe map. We have strength then coming through on the European equities, up by 0.8% this morning. There's the earnings story. I said banking on IT in the headlines. I meant to say banking on it, of course, just to correct myself, because some of the bank earnings have been pretty strong. We'll come to those in just a moment. But this is what we have on European markets. Right now, we see that the CAC 40 is up by 1.4% and the IBEX and the FTSE MIB doing pretty strongly this morning as well. On to some movers. Let's get to some of those detailed stories, including one of the banking names. These are the ones that are moving higher for you this morning. So let's go to Hermès first. This is the luxury maker of watches and clothes and leather goods in France. Second quarter sales beating estimates, demand for watches and clothing. So after we heard from LVMH and Kering and other luxury names, Hermès seems to be picking up that baton and running with it in style. NatWest is up by 7.3% this morning, better than estimated numbers coming through there. An impairment release instead of an expected charge, and also a special dividend from that British bank. And Renault up by 6%. Yes, the numbers, if you look back, look disappointing. They had to take a big hit on their Russia business and pulling out of Russia, but they are guiding higher on the rest of the company. Let's move to the downside. So stocks that are losing ground today, and AstraZeneca in focus, the drugs maker here in Europe. And actually, this is the only sector, one of the few sectors in Europe that is in negative territory today. So EPS came in above estimates. They've actually increased their revenue guidance, but some analysts skeptical, saying it was one-offs that fueled the beat in the first place. We've got Vivendi down by 4.6%. The profit missing there, a cautious outlook according to some analysts, and Prosus down by 4%. If there was an area of weakness through the Asia session, it was around Chinese technology shares, and with that as the narrative, that weighs on Prosus, which has, of course, exposure to Chinese tech. Now, meanwhile, let us get back to the big macro picture. The US economy contracted in the second quarter as inflation undercut consumer spending, and Fed rate hikes stymied business investment and housing demand. Meanwhile, Janet Yellen shrugged off recession talk, saying a true recession is a broad-based weakening of the economy.
We do see significant slowdown in growth. That's to be expected, given how rapidly the economy grew when it was recovering from the pandemic and all of those job losses, and policy was designed to do that. We should expect to see a slowdown. This economy is at full employment.
Let's get analysis now with Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity International, who's with us this morning. Salman, very nice to have you with us. Let's take a moment to think about where we are on the global growth story. We'll start with the United States then. Janet Yellen talking there about what a recession is in her mind. Of course, the US in this interesting position where they have a body that officially decides whether they are in a recession or not. You have to wait a long time for that. So what is your view as we wait for them to decide?
Good morning. So our view is that there is a significant slowdown, but a contraction in GDP, which basically has a meaningful impact on markets, will lead consumption to come under pressure. So there is a slowdown in personal consumption expenditures from Q1 to Q2. And that's probably the main story which we read out of those two estimates which have come out of the Q1, which was negative first, and then another Q2 which posted negative. But that's the thing we have to keep in mind because that if the consumption slowdown continues, and that will feed into the labor market, that will feed into a broad-based contraction, which basically will categorize as hard landing. But there's no doubt that the US economy is slowing down right now.
Slowing down, but do you think there's no doubt we get a hard landing as well, Salman?
So our actually base case is that we will get a hard landing in the US in the next few months, and our soft data trackers are consistent with those numbers. But I would say that Q1, Q2 data is not consistent with a hard landing. We would need much more damage, especially as I mentioned on the consumption side, but also a meaningful increase and a visible increase in unemployment rate, and that would to our minds would be noted as a hard landing.
Okay, and do you see any signs of weakness in the labour market as yet? I mean, what's the if we think about the time horizons involved here, when do you think we're going to see substantial weakening in the labour market? We've heard anecdotal evidence from certain companies that they are either freezing hiring or looking to get rid of people, but labour markets are so tight.
There is no doubt, the labour markets are very, very tight right now, but there is a delta change happening. We are picking up through our trackers that some of the pressure is coming down, but it's not consistent so far with the weakness in soft data. So it's the soft data, especially, for example, the business surveys, their components, and especially the future activity components are the ones which are flashing properly red. And based on historical calibrations of the 7-8 recessions we have done between the soft data and hard data, the lead lag can be up to a quarter. So this Q3, Q4 is the critical stage where we think that there should be a visible increase on the pressure on the labor market, because that's the last bit, a big bit, which is still showing very strong resilience despite the fact that we have so much tightening.
We've had some unexpected strength, I suppose, at least in the short term, in the Eurozone growth story this morning. We'll wait for the full Eurozone picture in 50 minutes' time, Salman. But in the run-up to that, we had France beating estimates, Spain beating estimates, Italy really beating estimates, Germany, though, looking very different and looking very stagnant at this point. Of course, the questions, though, are ahead. They're about the winter. When do you think we learn the extent of the weakness in the European story?
So on that front, I think the signs are already there. So the fact that Germany underperformed the rest of Eurozone countries is because of its higher dependence on gas flows from Russia. Obviously, that disruption has increased further, has become much more is in a much worse state. And then the rationing plans, which are now starting to come through, we think that they will get accelerated. The calibration we have done is that if gas is completely shut down or stays at the current very low levels from Russia, you're talking about a 5 percentage point shock to GDP for Germany. So this is just the start of the story. And Germany would be the one which will face most of the pressure because of its dependency. The spillover effect on other countries will come through in Q3, Q4.
Okay, thanks so much, Salman. Thank you for joining us. Salman Ahmed, in fact, he stays with us. We'll have more from Salman in a moment. Global Head of Macro and Strategic Asset Allocation at Fidelity International. Let's have a quick look at where we are on the pre-market on Amazon and Apple. We know that Amazon rallied really strongly after hours, so no surprise to see in pre-market that we are up by 12.4% on the Amazon share price. Apple also delighting to some degree investors, and that stock up in pre-market, up by 2.8%. So NASDAQ futures are up by 1.4% as we reflect on all that we've learned about the tech sector this week. Coming up, we continue the markets conversation. We'll get back to the earnings stories. We'll put questions around earnings to Salman. That's coming up next. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards, in for Francine Lacroix in London. We're wrapping up an intense week of earnings. We're now seeing inflation is hitting consumer demand, with Diageo and Unilever trying to keep their prices as low as possible. In comparison, luxury goods remain in high demand.
We certainly are seeing continued inflationary pressures on our cost of goods.
What we try to do is offer a good, better, best assortment in our portfolio, so people who need a more value offering can find it in the Unilever portfolio.
We're not sensitive to where people spend or what they spend on. We're only sensitive to how much they spend in total.
So far, we have not seen any reduction in demand for Mercedes. So demand for us currently is strong.
Big brands gained market share versus private label during COVID, and in some categories in some countries, we are seeing a strengthening of private label market shares.
A business like ours, we have multiple levers that help us to handle the inflation. We are very surgical and careful on how much pricing we take and where.
Let's get back to Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity International. Salman, so we've heard a lot on the earnings front this week. There's been a lot to digest: pricing power, buybacks. We've had all kinds of different themes going on here. Broadly, you are underweight equities. Has that view been reasserted? Have you been reassured in your view there by the earnings season so far?
So the earnings season for Q2 has been a bit more of a mixed bag. There are clear-cut signs of weaknesses in some of the sectors which we are interested in, especially which are related to the consumer side of things. But there has been, for example, the beat from Amazon and Apple. There are some signs that the economy is probably not slowing down as much as we thought. There are also some signs of, very importantly, supply side issues starting to get better. And I think Apple was an interesting story on that front, where the supply chain, the cost pressures coming from supply bottlenecks are reducing. So we have to take those into account. But we remain of the view that the most of the damage to economic activity is a Q3 story, not a Q2 story. And there is a little bit of a real view mirror dynamics going on in the earnings profiles right now.
Okay, so you think there's still damage to come then, Salman? So how do you think estimates then will need to be downgraded into the next earnings season?
Our Fidelity analysts are below consensus, and we do think that further earning revisions will be on the negative side. And that's if you look at, for example, consumer confidence data, which is at all-time low, the housing market affordability, which has collapsed in the US, of course, the gas disruption ongoing in Europe. We do think that obviously the corporate sector earnings will be exposed to all these forces, and the risk is towards negative earning revisions going forward.
You say you prefer emerging markets when it comes to equity, Salman. Why is that? Because some might be struggling with dollar-denominated debt or for other reasons. Tell me a little about what's driving that emerging markets call.
It's mainly China. So China economic cycle has been completely delinked and decoupled from the rest of the world because of COVID policies. And of course, the valuation stress they experienced as a result of that was quite extreme. So as zero COVID policy becomes much more dynamic, the application becomes a bit more liberal. The bounce back in growth, we think, will be strong, and that should help some of the valuation stresses we saw in some parts of the market. And that should spill over with some of the EM countries, but we'll have to be very selective here for sure.
Do you see signs of that more liberal policy in China?
We are seeing, for example, our onshore analysts are reporting that testing, for example, has become much more targeted. We are also seeing, obviously, signs of vaccination pick up in a big way. What is actually in the last recent couple of weeks, what we have become a bit more concerned about is the mortgage delinquencies and the boycotts rather than COVID per se, whereby the pressure on the property market may come again. That's what we are focused on right now, rather than being concerned about reapplication of a stringent ZCB policy.
This month has been a strong month for stocks and for bonds, Salman. The best. In fact, you have to go back to the end of 2020 to find a better one when it comes to global stocks and global bonds. Does that make sense to you? Do you think some of that, back to where we started the conversation, really, I suppose, do you think some of that faith in a pivot from the Fed, if that's what's been driving this positivity, do you think that's well-founded or misplaced?
We are very skeptical about this kind of relief rally, given that most of the damage lies ahead. And if you look at the Fed statement and the communication coming from Chair Powell, you can read it anyways because it was very flexible, open-ended. If the data is, for example, inflation data surprises again, we are looking at another 75 basis point. So there's a lot of hope there, and I can understand why, because we fell in terms of drawdown quite sharply, but most of the damage is ahead of us, not behind of us, and that worries us.
Okay, and what about global bonds and government debt? Salman in particular, some people are talking about how a lot is uncertain really about how the bond market will perform, yes, during a time of recession, which might drive demand for the perceived haven, but also at a time of high inflation, not like recessions that we have known most recently.
So we are long global bonds, i.e. duration risk. And the reason behind that was because of the rising fears of recession. And to your point, this is a very different cycle in that regard, that inflation is much higher, the starting point is much higher, and it may settle at a higher level than we have been used to. Then that means that nominal levels of bond yields have to be recalibrated. But the delta, the direction of pressure for us is still that, that bond yields can compress a little bit more from here as recession becomes more clearer, and the Fed will have to stop the hiking and in fact we may have to start thinking about cuts going forward, but we are not there yet. And in this regard, we like bonds versus equities.
Okay, Salman, thanks so much for your time. Good to speak to you. Have a good weekend when we get there. Salman Ahmed's Global Head of Macro and Strategic Asset Allocation at Fidelity International. Coming up later in this program, we'll get back to the earnings story. L'Oreal sales climb as demand for makeup bounces back. We will speak to the CEO of L'Oreal, Nicolas Hieronimus, will be joining us at, in fact, just coming up a little bit later on, 9:40 London time. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Let's get a Bloomberg First Word News update with all the top stories we're covering this morning. Here's Leanne Gerrans. Good morning, Leanne.
Good morning, Anna. US President Joe Biden and his Chinese counterpart Xi Jinping are planning an in-person meeting after a call yesterday. Tensions are rising over Taiwan, with a possible visit by House Speaker Nancy Pelosi complicating relations. If that meeting happens, it would be the first face-to-face meeting between the two since Biden became president. Now, the drumbeat of recession in the US is growing louder. The economy shrank for a second straight quarter as inflation takes a bite out of consumer spending. Well, that may define a recession in many other countries. The US waits for an expert panel to decide before declaring a recession, and Treasury Secretary Janet Yellen is giving a positive take on yesterday's data.
We do see significant slowdown in growth. That's to be expected given how rapidly the economy grew when it was recovering from the pandemic and all of those job losses, and policy was designed to do that. We should expect to see a slowdown. This economy is at full employment.
There is a risk of recession in Europe. That is the take of ECB Governing Council member and Bank of Italy's governor, Ignazio Visco. He says the central bank's decision to hike rates by 50 basis points gives them room to make data-dependent choices at future meetings.
There is a risk of a recession in Europe in all our assessment, mostly linked to the developments of the war. And if at the end there is a cut in supply of gas from Russia, these may have clearly substantial negative effects.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Leanne, thanks so much. We'll get back to the tech sector. NASDAQ futures point higher. We'll get analysis next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Technically speaking, the U.S. shrinks for the second straight quarter as raging inflation undercuts consumer spending. But Janet Yellen insists the country is not in a recession. Prime time. Big tech stocks open higher in pre-market trading after Amazon and Apple's resilient results. Plus, banking on it. Standard Chartered, NatWest and BNP cheer investors as earnings beat the street. Shares in the lenders rise. Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in for Francine Lacroix today in London. It has been a busy morning for European bank earnings, many offering positive outlooks as well as beating estimates. We spoke to Standard Chartered CEO Bill Winters, NatWest CEO Alison Rose, and BNP Paribas Lars Machenil.
I think the inflation problem we've got is quite substantial and reasonably intractable. So I think the Fed's going to have to hit pretty hard. So I guess that means a terminal rate at 3.5 or maybe even 3 3/4 or 4%. Is that what it takes to tip the U.S. into recession? Yeah, I think so. Speaking candidly, but we hope for the best. And I think Europe obviously has the incremental burden of energy prices, and that's tough.
Deposits still remain very strong. What we're seeing is households have a buffer in terms of the cash deposits, and there is still a huge amount of liquidity sitting on corporate and business balance sheets. What we're seeing at the moment in terms of debit and credit card spending for our customers is actually, although there are increases clearly, particularly in fuel and energy prices, the real increase in spending at the moment is on travel and hospitality.
The growth will not be the growth that we would have thought 6 months ago. Yeah, so that environment will be different. But how exactly will it be? Will it be a slowing down? Will it be a technical recession? So basically gravitating towards zero. What will it be? Listen, as I mentioned, I don't have a crystal ball. The thing that has to be there as a bank, we have to be there to help our clients in all of these circumstances.
Thoughts from the banking sector. Let's get analysis now. Bloomberg's Tom Metcalf joins us here on set in London with thoughts on what we've heard so far. Tom, good morning to you. We've heard so much from the earnings season this week. What has stood out for you?
Well, certainly the bank that stands out is Credit Suisse. We can dive into that in a bit more detail, just in terms of individually what a mess it continues to be. But I think it's kind of going across a whole sort of real variety of European banks. One is it's a pretty positive outlook in terms of provisioning. So NatWest today, for example, they actually released impairments, which is really quite extraordinary.
Yeah, there'd been an expected charge, hadn't there?
Exactly. So a complete, a reversal, and that really suggests they're still seeing very little defaults. They're pretty confident, and that seems to be the message. Is everyone's saying, "Oh, this is quite benign," and then you contrast that with some, slightly pessimistic comments and some pretty pessimistic economic data. So I think maybe for me the thing is there's almost a time lag. They haven't seen any kind of hit yet on defaults while they're benefiting from these net interest.
Yeah, so is that the message that we take away on the UK economy, that, well, the banks have not been hit yet by any expected slowdown?
Yeah, I would expect as quarters go forward, you'd see a bit more negativity and perhaps, more impairments. But right now, pretty much across the board, Barclays, Lloyds, NatWest were all pretty positive.
And I suppose Credit Suisse was always going to stand out because of the management change and because of the issues with their performance. And they stand out even more so when the competition is doing pretty well.
Yeah, exactly. I mean, it was, I think, come on before and said, well, I think the thing they were really aiming for this quarter was sort of a clean, quiet quarter, obviously big restructuring there. And that's the thing, we took a look at their investment bank, and, while the US banks, a lot of the European banks have seen really strong trading quarters, at Credit Suisse, for various reasons, it was absolutely tanking.
Okay, do we have more banks to report next week? What are we looking ahead to in the world of financials?
The one I'm really looking forward to is HSBC on Monday, and that is obviously, a bit of a bellwether for the UK and also Asia, but it's particularly interesting at the moment. Obviously, there's this Ping An sort of pressure to maybe break up the bank, and then on the Tuesday after their results on Monday, they're actually meeting with their Hong Hong Kong retail investors. So maybe we'll see some progress around that whole issue.
Okay, interesting one to watch then, Tom. Thank you very much. Bloomberg's Tom Metcalf with the latest on the banking sector. Let's go from banks to tech earnings. Major US technology and internet stocks have opened higher in pre-market trading after Amazon and Apple both issued resilient results in a difficult economic backdrop. Let us speak now to Matt Bloxham from Bloomberg Intelligence. Matt, good to speak to you once again. I feel I've spoken to you every day. That might be true. We've had so much to talk about on the tech front, haven't we? Let's start with Amazon then, because this is the big mover, isn't it? Both in pre-market, well, after hours and now in pre-market. What was so good at Amazon?
I think the most important thing was what they said on costs. That's been the big worry for the last 2 or 3 quarters, because they invested so much in warehouse and staff to kind of through the pandemic. That caught up with them on margins, and a very clear message that in the quarter that's under control, and that it's going to be an incremental focus going forward, particularly in terms of headcount. I think interesting, they said they're going to shift their spending towards the cloud business, so that tells you where they think the growth opportunity is, certainly in the near term.
And you've always talked about that as being a profitable part of the business.
Yeah,
that's what's driving profits.
Absolutely, it dwarfs everything. I mean, the e-commerce side is still loss-making, as all of the profit really is coming from the web services business right now.
That's amazing, isn't it? In terms of the outlook for the US economy, did we get any clues here? Because clearly after Walmart, everyone was nervous about what the US consumer is doing, but Amazon is a global business. Did they shed any light on the consumer?
Not much, but I guess it was a sense of optimism. Perhaps a little bit like Tom said, you know, a lot of these companies are not seeing the slowdown yet, and they'll only talk about it when they see it. But they were certainly confident that they're not seeing a slowdown in spending from their customers, and they're confident that they'll continue to spend on the Amazon platform going forward.
And what about Apple then? Let's move over to Apple. So this one also called up pre-market, seen trading higher. iPhone sales, so back to the bread and butter of Apple, really.
Exactly, yeah. So the iPhone sales were slightly better than people were expecting. You know, still a bit weaker than historic trend, but just north of $40 billion in the quarter. People were looking for 39 billion and change. And again, confidence from them that with the product refresh that we normally get in September, that it's going to continue to see strong demand, and potentially some light at the end of the tunnel on supply chain issues.
I was going to ask, are they seeing that? Because there are some sectors that still seem to be plagued by those supply chain issues. Certainly, we talked to car companies, and also some medical technology like Philips, still talking about supply chain issues.
Yeah, again, very mixed messages, I think, this quarter from different companies about what's going on with particularly chip supply. I think the message from Apple is that it's still a problem, but they're working their way through it, and they can see it becoming less of an issue for them through the second half of the year.
Okay, Matt, thanks so much. Thanks for joining us. Matt Bloxham, our tech analyst with Bloomberg Intelligence. Lots to discuss then when it comes to the earnings stories. Let's bring you up to date with some of those and get a Bloomberg Business Flash. Here's Leanne Gerrans.
Hi, Anna. Citigroup is requiring some of its least profitable trading clients to post more collateral and is even dropping some of them to help boost returns in its markets business. The moves have helped the unit make progress on its efforts to improve its ratio of revenue to risk-weighted assets, a key focus for the bank. Now, Comcast saw its biggest drop in more than 13 years yesterday. That is after its prized internet business added no new customers last quarter. It's an absence of growth not seen in decades and is due to a housing slowdown and also heavy competition. Analysts expected around 83,000 new subscribers for the quarter. However, none of them predicted the gain would in fact be zero. And pharma giant AstraZeneca has raised its outlook for 2022. That's after second quarter revenue and earnings per share beat expectations. The results were fueled by growth in all disease areas, including treatments for COVID-19. Sales jumped 48% in the first half of the year. And that's your Bloomberg Business Flash. Anna.
Leanne, thanks very much. Leanne Gerrans there with a Business Flash. Coming up on the programme, back to earnings, and L'Oreal sales climb as demand for makeup bounces back. We talk earnings with the CEO, Nicholas Hieronimus. He's with us next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Let's get some more on the earnings news now. L'Oreal sales climbed as demand for makeup bounced back and the strength of its luxury products offset the negative impact of COVID-19 restrictions in China. We're joined now by the CEO of L'Oreal, Nicolas Hieronimus. Very nice to see you, Nicolas. Thank you for coming to talk to us. So strength in these numbers, and the market is rewarding that. The stock up by 2.9% right now. You've been pivoting further towards the luxury end in recent years. How much do you think that is helping you at this point?
Well, I think overall, rather than pivoting to one end, what I highlighted in my comments about this half's great results is the balance of the performance of L'Oreal between divisions and regions. You're right to say that luxury has been driving a lot of the growth of L'Oreal for years, and it has become a #1 division. But I'm happy to say that our consumer products division has really accelerated with +9 on Q2 and is driving our growth in the emerging markets. So today we have a very balanced growth between Chinese consumers, America, Europe, and emerging markets. And that's really helping us being both agile and that's very useful in this very VUCA environment.
Yeah, Nicolas, what is your experience with different types of consumers at different price points? Because across the consumer-facing sectors, we've heard very strong stories coming through from luxury names and slightly more measured stories, maybe challenged stories coming through from lower-end consumer-facing products. What are you seeing in your consumers? What's the story you tell?
Well, what I'm seeing is that consumers, after 2 years of pandemic, want to indulge themselves with high-quality products and pleasure products. And beauty is part of these affordable pleasure products. But what's very important, and it's across all price points, is that people want high quality. That's why the market is premiumizing. And of course, luxury provides this high-quality products at a high price. But if I look again at our other divisions, whether it's our mass market with skincare serums or great hair care products with hyaluronic acid, or our active cosmetics brands with a brand like CeraVe or La Roche-Posay with ultra effective sun filters, in all instances, people are actually, even when they're counting their dollars, they want to buy the best quality. And this quest for the best quality is what drives the L'Oreal performance.
So if the business is, if consumers are premiumizing, Nicolas, to use your word, are you seeing no evidence of consumers trading down to cheaper options?
Absolutely not. We are, of course, very aware of the uncertainties ahead, and we are, preparing for everything. And that's why, by the way, it's such a great thing for us to be a pure player in beauty and have a price piano, if I may use that term, that starts from shampoo at $3 to creams at $300, so we can satisfy everybody. But really, today, we do not see consumers trading down. On the contrary, as I tell you, they are investing in quality, and our best products and our best brands are the ones that have the fastest growth.
There's a debate about whether the US economy is or isn't in recession. A lot of people saying no because unemployment's still low. Here in Europe broadly, and in particular in the Eurozone, there's a debate about whether we'll see a recession in the Eurozone through the winter. Are you preparing for tougher times ahead, Nicolas?
Yeah, we are preparing for tougher times, and at the same time, we remain optimistic and bullish. We are preparing because we have to prepare for any event, and we've proven at L'Oreal during the COVID-19 crisis that we could outperform the market, protect our profitability, and that we continued, even though stores were closed at the time, to invest in launching new products. So we are preparing for what's ahead, and we have new innovations. We have monies to spend in advertising to seduce consumers. But at the same time, we remain optimistic because beauty has proven across history its incredible resilience, particularly in times of trouble. By the way, we have, you've probably heard of this famous lipstick index theory, which whereby women and maybe men in the future are using more lipsticks when times are tough. And right now we see this appetite for indulgence. So we don't know what's ahead. And I said we are prepared for it. If there's any downturn, we'll be able to cope with it, but we'll remain bullish and optimistic, and we want to bring out new great products to consumers.
Nicholas, what do you see on the supply side? Are you having difficulties with supply chains at all? Some businesses, some industries are still facing that post the COVID challenge.
Yeah, of course. We are not immune to the global tensions. There are, of course, differences between parts of the world and categories. We have more difficulties in the USA, for example, than we have in Asia. And some of our skincare, our very successful skincare products have been facing shortages and insufficient service levels. We also see tension on the fragrance category because this category is booming, and we are at plus 35% after 6 months on the same type of growth last year. So there are some shortages, but I would say we manage overall, thanks to our global cloud, our negotiating power, and the agility of our operations team to weather through these difficulties and still manage to deliver some good results.
Can I ask about China? You mentioned that one of the strengths of the business is its geographical spread, Nicholas. But in China, of course, a number of businesses still facing issues created by intermittent lockdowns. How is that playing out for L'Oréal right now?
Well, I think that's probably the performance I'm most proud of, because I kept on hearing questions about how terrible was the situation in China with the lockdowns. And it's true, it was difficult, and the market was negative in April, May in China, and bounced back a little bit in June with the end of the lockdowns. But we did a fantastic performance in China. We grew by 8% in Q2, and if I take the overall Chinese consumption, so Chinese buy in China and maybe in some travel retail areas, we grew double digit. And that's thanks to, of course, the agility of our team, the strength of our brands, which are loved by Chinese consumers, but also it's linked to our extreme strength in e-commerce. Over 60% of our business in China is done in e-commerce, and we master that game pretty well. And when stores are closed, people can still order online, and that's allowed us to grow, to lead the famous 618 festival, which is a big shopping festival in China. And I'm still very ambitious for our business there, because we've only scratched the surface. We serve 100 million consumers in China when there are 400 million that could afford our products. So we still have some work to do. Great teams there and great brands.
Nicholas, thanks so much for your time. We appreciate it. Thanks for coming to talk to us, Nicholas Hieronimus, the CEO of L'Oréal. Coming up on the program, we'll get back to geopolitics. US President Joe Biden and his Chinese counterpart Xi Jinping plan for an in-person meeting as tensions continue over Taiwan. More on that story next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in for Francine Lacroix in London this hour. Let's get back to geopolitics. US President Joe Biden and Chinese President Xi Jinping told aides to plan an in-person meeting during a phone call yesterday. That's according to a US official. It comes as both leaders stake out their positions in a simmering dispute over Taiwan. Joining us now is Bloomberg News' Bruce Einhorn. Bruce, nice to speak to you. So what came out of this phone call?
Well, Anna, it's interesting. The point about the visit or the upcoming meeting between the two presidents in person, that's something that a U.S. official said the two presidents discussed. The Chinese notably did not mention that in their readout of the meeting. This is the fifth time that the two presidents have had this kind of call over the phone, or they still haven't met in person. They spoke for about 2 hours, 20 minutes. We know that they went over positions regarding Taiwan, no new ground there, just both sides reiterating their existing policies about Taiwan. According to the U.S., President Biden did not bring up with President Xi anything about tariffs. There's a lot of discussion now about whether President Biden is going to ease some of those tariffs that are still in place from the trade war under the Trump administration. There's still a decision likely to come sometime soon on that, but in this call, it's not something that the two presidents discussed. There was a lot of talk about Taiwan, though.
Yes, absolutely. So on that subject, what will happen if House Speaker Nancy Pelosi does go to Taiwan?
Well, we don't know if she's going or not. Let's be clear. She has a trip scheduled for Asia in August. There are several places on her itinerary, on her official itinerary. Taiwan at the moment is not, and her office has not confirmed whether or not she is going to go. President Biden did say last week that the military, U.S. military, doesn't think that a trip right now would be a good idea. China, of course, considers any visits to Taiwan by officials of that stature to be violations of the One China policy. It's worth noting that this would not be the first visit by a U.S. speaker to Taiwan. Newt Gingrich, who was Speaker of the House back in the late 90s, did make a trip there. So there is precedent for this. That said, these are very different times. U.S.-China relations are much worse than they ever were back then. So the equation is quite different this time, Anna.
Yeah, Bruce, thanks very much for the update. Bloomberg's Bruce Einhorn with the latest on relations between China and the United States. Let's stick with geopolitics. We're currently getting pictures coming through from a press conference being given by the Russian Foreign Minister, Sergei Lavrov. You see him speaking there. These pictures coming to us from Tashkent in Uzbekistan. He's speaking at the Shanghai Cooperation Organization. He says he's agreeing a time for a call with Anthony Blinken, of the United States, of course. He's also saying he'll listen to prison swap proposals, so we'll see if anything comes of that. But we are getting these live images coming to us from, as I say, Uzbekistan. From geopolitics back to the markets, and European stocks have been doing pretty well today, mostly on the back of the earnings story. We see a lot of positive reaction to earnings, but also broadly around the earnings tech story coming out of the United States. So the stock 600 up by 0.8%, the FTSE up by 0.6, the CAC are doing pretty well today, the IBEX and the FTSE MIB also. So we are seeing strength across Europe. The Nasdaq futures picture representing or indicating the optimism around those Amazon numbers, and Apple, both of those after hours, provided some reassurance perhaps to a nervous tech investor. And the euro is at 102.19, up 0.2%, but actually maybe it's more dollar weakness. This is a risk-on day then for global assets, and that tends to weigh on the dollar, and we see money going into the euro. I was going to say also into the pound, but that's turned around. Not so anymore. The pound just edges a little lower. And we're waiting for an OPEC meeting next week, so the Brent price of interest as it keeps edging upwards. Quick word on some of the movers. We've seen some strength coming through in earnings from Hermes, from NatWest, and Renault. All of those stocks are moving substantially higher on the back of numbers coming through there. And to the downside, though, AstraZeneca apparently relying on one-offs, according to the one analyst at least. So that's weighing on their business, despite the fact they guided higher on revenue. Vivendi also under pressure, as is Process, given their connections with Chinese tech. That is it for Bloomberg Surveillance Early Edition this hour. The program continues. Kaylee Lyons and Matt Miller will join me from New York. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
What we're seeing is what you would expect. Financial conditions tightening, the economy slowing down.
This economy has materially slowed down. We are not in the roaring 20s. We are not in the reflation trade.
Our concerning still leave us with more of a bearish tilt.
I think ultimately what's going to drive things like rates or FX is the relative growth concepts.
The dollar could remain firm despite the issues of the U.S. economy.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Traders focus on recession instead of inflation. That's led global bonds to their biggest monthly gain since 2020. Today, investors are waiting for data on the Fed's preferred inflation gauge. We get PCE deflator, U.S. personal income, and consumer sentiment. Big tech comes to the rescue. Amazon and Apple surprise Wall Street with quarterly sales results. And Joe Biden and Xi Jinping now plan to meet in person. But the question of whether House Speaker Nancy Pelosi will visit Taiwan could complicate matters. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London, Matt Miller and Kaylee Lines in New York. And Kaylee, we've got real strength of sentiment here in European equity markets driven by European corporates, some data also out here in Europe, but also the tech themes coming through from the US.
Yeah, and that's definitely lifting U.S. futures as well. But what's noteworthy, Anna, is Asia really sat out those gains. The MSCI Asia Pacific Index as a whole literally flat on the day, but the real underperformance came from big Chinese technology stocks. The Hang Seng Tech Index down almost 5 full percentage points, and that was in large part due to Alibaba. Those shares were down more than 6% on reports that Jack Ma will be ceding control of the fintech arm Ant Group. Of course, the regulatory overhang still very much front and center, as is the fact that we didn't have any more stimulus promises from the Politburo out yesterday, so that really damped down sentiment in the entire region. And of course, we've seen a massive rally in the bond market. That was true in treasuries yesterday. You saw Australia following that move with the 5-year yield down almost 19 basis points. And the action in foreign exchange, really, to me, the yen is the standout, Matt. The yen headed for its best 3 days against the US dollar, going all the way back to March of 2020, which of course was the height of the fear around the pandemic. The dollar yen right now trading right around 133. That is the strongest Japanese yen we have seen since mid-June.
Yeah, very serious strength there. Very surprising. Let's take a look at what's going on in S&P futures. This is not a surprise, up about 0.6% after some really strong earnings, although is good news really still good news? Take a look at what's going on in the 10-year yield. Investors are selling the bonds, pushing the yield up, but still at a relatively low level. 270.48 is the level we're looking at on the 10-year. NYMEX crude gaining a couple of dollars a barrel, up to 98.35. I guess the strength in the economy is giving people confidence that drivers will continue to put the miles down. And Bitcoin right now off about 0.5%, but it's at a relatively high level, almost $24,000 a piece. So while normally it would be correlated to futures, or really more likely NASDAQ futures, it looks like it's going the other way, at least since 5 o'clock last night. And Anna, what do you see in terms of the euro area response to the strong GDP numbers?
Yeah, really interesting to see that we had running into the GDP numbers that I'll get to in a second. We had strength across Europe, and we continue to see that. You can see on the map we've got a strong earnings picture coming through from European corporates, and that seems to be the driver today. There is perhaps also a little bit of focus, as you say, Matt, on this GDP number. So we've got euro area GDP coming in plus 0.7% in the second quarter. The median estimate have been an increase of just 0.2%. So just as we'd seen in the component parts of this number coming through from France, and Italy, and from Spain. Actually, unexpected strength, supported in places by tourism, but unexpected strength in the European growth story. What is a bit more worrying, though, is, of course, what happens into the winter and also what's going on inflation. So the euro area July consumer prices rising by 8.9% year on year. That is another new high on inflation. The estimate was for an increase of 8.7%. We've seen country after country coming forward with new highs on inflation. And so those two narratives running in parallel as we consider where we go next on the Eurozone economy, essentially. Let's show you what's driving the session today, though, because if it isn't fears about growth, it is excitement around growth numbers coming through from certain corporates. We've got Brent crude up by 1.9%. Matt, you mentioned the broad risk-on appetite driving the oil price higher today. NatWest Group up by 7%. The company, this bank in the UK, beating estimates and, in fact, actually reducing the amount of money they're putting aside for bad debts. And the market have been expecting them to increase charges on that front. So that was interesting. A more optimistic picture being painted about the UK economy. Renault up by 3.4%. Yes, if you look backwards, there were difficulties and costs associated with pulling out of Russia, but the guidance they gave did please the market. And L'Oreal, this is a beauty products company, of course, based in France. I just spoke to the CEO of L'Oreal. The company up by 2.9% today. It seems that move more and more towards luxury has been helping the business, but also the breadth geographically and in terms of product also driving this business higher. And apparently they do 60%, Kaylee, of their sales in China online, and that has been something that helps during a lockdown.
I guess that makes sense when people can't necessarily go outside. And of course, we'll be speaking with the CEO of Renault later on this hour. As for what is ahead later on today, U.S. House Speaker Nancy Pelosi will be leaving for her trip to the Asia-Pacific region. We know where she is going. The question mark is, will she also go to Taiwan? The big oil companies report their earnings results, with ExxonMobil and Chevron both reporting before the bell. And we'll get some very important U.S. economic data, including personal income and spending, PCE, and that employment cost index that Jerome Powell talked about on Wednesday, Anna.
Let's get back to some of those tech themes then, Kaylee. Apple's third quarter revenue and profit narrowly topped estimates, with iPhone sales holding up better than expected. Speaking about Apple's long game, CEO Tim Cook told Bloomberg, quote, "We believe in investing through downturns. We've always done that and have found that made us stronger on the other side. That's the frame of mind we go into." Meanwhile, Amazon showed its e-commerce and cloud computing businesses can churn out revenue even as consumers worry about inflation and the company gets serious about curtailing expenses. Matt Bloxham, Bloomberg intelligence analyst, joins us now. Let's begin then, Matt, with Amazon, because this is the one that pre-market is seen, most on the move. Excitement where here? Around the revenue or about costs?
I'd say both, but probably more so on the cost side. Obviously, they've faced quite big headwinds to profits on the e-commerce side through the pandemic because they've built up such excess capacity and fulfillment, and they've started to bring that under control. So in the quarter, those costs were lower than expected, and they gave quite a strong message that they'll continue to focus on that going forward. They're going to invest incrementally in the cloud business going forward. That grew 33% in the quarter, so clearly still seeing a lot of opportunity for growth there too.
Apple also had results that pleased analysts, but Tim Cook listed off a number of headwinds for the company.
Yeah, he did. It's a challenging time for all tech companies. I think obviously supply chain issues are still a problem for them in terms of meeting demand. But I think they were showing some signs of optimism that those issues are starting to kind of fade a bit. So as they go through their next product upgrade cycle, expecting a new iPhone 14 to be announced in September, that maybe that will kind of they'll be able to sell more of that, and the supply chain issues won't hold back the potential there.
Okay, Matt, thanks very much. Matt Bloxham of Bloomberg Intelligence. Thanks for joining us. More on tech ahead. We will speak to the investor Mark Stokel of Adams Funds. His top holdings include Apple and Amazon, so plenty of analysis on the tech front. Let's get back to the data that just broke at the top of the hour around the Eurozone economy. We've been gradually building up a picture of strengths and weaknesses today. So on the GDP side, the quarter-on-quarter number for the second quarter up by 0.7%. That really much higher than the estimate. So GDP running much higher than was anticipated. Questions about the future, of course. The CPI numbers, the numbers there coming in higher than estimates as well, and that more worrying, of course. 8.9% is the inflation rate now for the Eurozone. It was expected to be 8.7. Joining us now with analysis, Marcus Ashworth, a Bloomberg opinion columnist. I guess we should reflect on the strength that we've seen in these growth numbers, some of it from tourism, Marcus, that sort of revenge tourism showing up here, but real strength in particular coming through in some places, Spain and in Italy.
Yeah, it's very much the southern part of the tourism strength, clearly, as you said, revenge holidays indeed. I could hear them this morning. The planes going over my house have definitely increased. But, you know, for sure, there's also not just tourism, but it's just opening up the economy. That trend is quite strong from the pandemic, you know, finally been over. There's a lot more activity going on. The outlier here, unfortunately, is Germany at flat, and I think that's something to keep a very close eye on. But let's celebrate for once a decent, much stronger quarter. How much of that goes through into the back end of the year and indeed into the winter is very much dependent, as always, as with inflation. As you can see, the numbers ticked up a bit there, 8.9. I don't read too much into that. I mean, Italy fell, for instance, so it's just bumping around. It's very difficult to get a clear-eyed read on inflation, other than the fact, as with growth, we're in the hands of what happens with the gas supplies over the winter coming from Russia.
So Marcus, does anything in this data change the calculus for the ECB?
Well, that's a good question. I haven't really thought about it that way. Not really. I mean, I think they'll take some semblance of hope, the fact that they did the 50 basis points and they've not walked straight into a horrible GDP number. So they'll be relieved that they've been able to do a sort of bold move, and it hasn't looked instantly terrible. Not to say it won't look a little bit scarier perhaps later in the year, but I think it does put the focus therefore back onto September and whether they do 25 or 50. And you could think certainly the argument to do another 50, if that's what they chose to do following the Fed, they could do that with a bit more confidence now.
They can run free, Marcus. They can run free on the beach of life because of this growth. Marcus Ashworth there, Bloomberg Opinion, thanks so much for joining us. Now, yesterday's GDP report for the U.S. showed a shrinking economy. On the back of that data, Treasury Secretary Janet Yellen held a press conference almost as if she had seen it beforehand. She spoke about the slowing U.S. growth.
We do see significant slowdown in growth. That's to be expected given how rapidly the economy grew when it was recovering from the pandemic and all of those job losses, and policy was designed to do that. We should expect to see a slowdown. This economy is at full employment.
U.S. Treasury Secretary Janet Yellen. So Kriti Gupta here on set with us. The administration is assuring us this is not a recession. Two quarters of contraction does not mean a recession all of a sudden. But the bond market seems to be down with that.
Yeah, it creates a really big bull case for treasuries, which is, by the way, the exact opposite of what we've seen in the last year or so. It's not just treasuries, it's bonds around the world, really. And you're seeing that in the complete transition from the inflation narrative to the recession narrative. To our radio audience, basically, you're looking at a chart here that is looking at global bond yields, and it's basically skyrocketing, a pretty steep decline, or incline, I should say, going to about 1 or 2 months ago, where you see a complete turnaround. And that turnaround, once again, it does create that bond bull case. And I think it's really important when we talk about where we're investing our money, because when you start to see this turnaround in the stock market, you tend to see an opposite reaction in the bond market as well. Right now, to see both stocks and bonds bid, I think that's pretty new.
Yeah, both global bonds and the S&P 500 heading for their best month since November of 2020. So it goes to show you how bad news seems to be bad news for the economy, but not necessarily for the stock market. Right. And of course, while we're speaking of the economy, we're going to get even more economic data at 8:30 a.m. Eastern. Spending, income, PCE, ECI. Which do you think is going to be the biggest catalyst for this market?
It's definitely going to be the employment cost index right off the bat, because there's Chairman Powell named it on Wednesday. He was very vocal about it. And remember, he's been very vocal about just how tight the labor market is. It begs the question, how much unemployment do we actually have to see for the Federal Reserve to be comfortable with this labor market, which once again is a pivot from what we heard pre-pandemic, where they were so proud of how strong the labor market is. Compare that to the Biden administration. You heard it from Janet Yellen, you heard it from President Biden yesterday, that a strong labor market is actually a very good signal. Remember, we also get the PCE data as well, which will complement the CPI numbers. But really, at the end of the day, it's the labor market that isn't being included in those headline numbers. So that's why the employment cost index is going to be potentially a market mover.
Chrissy, thanks so much. Bloomberg's Chrissy Gupta with the latest on the U.S. economy. Sticking stateside, House Speaker Nancy Pelosi is set to depart for Asia, but it's still unclear if one of her stops will include Taiwan. This comes as President Biden and China's Xi Jinping plan to hold an in-person meeting. Emily Wilkins, Bloomberg government reporter, joins us now. What's the aftermath of that call and the setup to this visit to Asia?
So Speaker Pelosi's office still has not confirmed that she will be visiting Taiwan, but we do know that the Pentagon is preparing for that potential trip, trying to figure out what the contingency plans need to be here. Obviously, an historic trip, first time for a speaker to visit the island in 25 years, but also coming at a time where Biden and President Xi are really trying to manage that relationship. You did see that 2-hour call between both leaders yesterday. The White House said that Biden and Xi are now going to try to get together for an in-person meeting, the first since Biden has become president. But Xi also had a warning for Biden. He said to not play with fire, seemingly referring to that trip that Speaker Pelosi is potentially leaving on today. She'll also be going to other areas in the Asia-Pacific region, including Japan and Indonesia.
All right, so that's on the foreign policy front. On the domestic policy front, of course, we had news earlier this week on the agreement reached between Joe Manchin and Chuck Schumer. Where do we go on reconciliation from here?
So we always talk about President Joe Manchin, but it's worth noting that any of the 50 senators are really important here. And right now, all eyes are on Senator Kyrsten Sinema. She's a senator from Arizona. She's raised concerns about tax provisions in the past, particularly that carried interest. She does not want to see that in the legislation. It is currently in there, expected to raise $14 billion over the next 10 years. Senator Joe Manchin says it needs to be in there. Everyone's waiting for Senator Sinema to say whether or not she will support it. If she doesn't, that's it, game over, unless they can figure out some way to work around it. Right now, though, the current delay would be with the Senate parliamentarian. Remember, not everything can go in this reconciliation package, so you have to have the parliamentarian comb through the language, give it a yay or nay, and that might wind up taking a couple weeks. One thing that we know is that lawmakers in the Senate, they're certainly expecting to be here next week, potentially even into next weekend, and House members are on alert that they could get a call within 3 days to come back to D.C. and vote on that package.
All right, Bloomberg Government's Emily Wilkins reporting from D.C. for us this morning. Thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. One of the big movers to the downside is Intel. After it cut both its revenue and profit forecast, the company's struggling with a softer environment and market share losses. The CEO, Pat Gelsinger, talking about how they just need more time to get competitive. That stock is down 9% before the bell. It's an even bigger move lower, though, for Roku. This, of course, is the TV streaming company, and perhaps no surprise, given what we've heard from the likes of Meta and Snap over the last week. They say advertisers are pulling back on spending, and that is going to weigh heavily on them in particular. That stock down 26% before the bell. But of course, the more positive stories out there include Apple and Amazon, which we were just talking to Matt Bloxham about. And those together represent about 10% of the S&P 500, even more of the NASDAQ 100. And as a result, QQQ, that ETF that tracks the NASDAQ 100, is higher by about 1% before the bell, Anna.
Lots to focus on at pre-market then. Coming up on the program, we will speak to Renault's CEO, Luca De Maio. We'll discuss the automaker's latest results. What are the challenges that they are facing right now? We'll get to that conversation shortly. This is Bloomberg.
This week on Bloomberg Green, the green energy of the future, how to make clean hydrogen. and its benefits for the planet. Flying high, we take a look at the practical uses of green hydrogen as jet fuel.
To hydrogen fuel cell being the best approach from the cost of fuel, efficiency of utilization of the fuel, and the mitigation of the climate effects.
And from a small part of the energy picture to making it available for all. We talk the challenges and opportunities in widening access to green hydrogen.
My biggest dream is to see green hydrogen become mainstream, actually, and not just to have these little pockets of applications or these demos, but for it to really become the fuel of the future.
From Bloomberg's world headquarters in New York, I'm Kaylee Glines, and don't miss the latest edition of Bloomberg Green, airing this weekend on TV, Quick Take, and online.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio.
Welcome back to Bloomberg Surveillance. This is the early edition. Now, Renault raised its outlook for the year as it sought to draw a line under a costly withdrawal from Russia that led to a first-half loss. Russia was Renault's second biggest market before the pullout. Joining us to talk about the results and the future is Luca De Meo, Renault CEO. And Luca, thanks so much for coming on the program. Let me ask first about the margins, because I saw 4.7% and you're looking to get to 5%. Now, from a U.S. perspective, I have to wonder, have you thought about making pickup trucks because they have much bigger margins?
Yeah, I mean, of course, you know, you have markets like U.S. that are very rich. We have never been able to, you know, penetrate this very important market, or markets like China. But I think in the European context for a volume brand is already a decent performance. It's probably one of the best performance we did in the last 10 years, both in terms of cash and margins and unit margins. And we are looking at, you know, developing the business because I think we still have a lot of, you know, to improve compared to some of the best competitors. But we are optimistic. We did a lot of work in the last couple of years.
What about the U.S. market? I mean, my first car was actually a Renault GTA convertible, fantastic machine. But we really haven't seen the brand in this country since then. Are you ever coming back? Could you partner up with someone else to bring cars back to the U.S.?
But it's in our wildest dreams, but so far we don't have a concrete plan. But especially with some products like, and some brands like the sportier brand like Alpine, it's potentially a market that could, you know, be interesting, and where, you know, American consumer might be interested in our offers. But we're now concentrating on Europe because we have to catch back, you know, market share and get back to our historical position, and so that's the focus of our activity in the next months. But you know, why not? You don't have to, never have to close, you know, the door to dreams.
Okay, yeah, keeping Matt's dreams alive. Anyway, Luca, good morning. Let me ask you about the chip story. We spoke to Carlos Tavares yesterday at Stellantis, who said he expects the chip supply issues to be resolved by the end of 2023, so still more than a year off. What's your time horizon? How do things look to you?
I don't think we have full transparency. I think there's scarcity of semiconductors. It's becoming, at least for our industry, relatively structural until we get into a new generation of products on our side. But the situation is getting much, I would say, better. We don't have the full transparency and stability we had, you know, a couple of years ago. But when I see May, June, you know, we were supplied, and when I look at now to the end of the year, we have, you know, we are confident that we can, you know, do the year properly, although it's a very complicated supply chain, like on many other, you know, components.
Yes. Luca, I wonder how resilient you see consumers as being as we face lots of questions, certainly in Europe, going into the winter. What we're seeing from other consumer-facing businesses in other sectors is the luxury end seems to be holding up well. The challenges seem to be at the lower income consumer end. How do you think that will play out for Renault?
I mean, we have, we actually have three brands in the house. One is Alpine, is the sporty, more premium brand. Then we have Renault is the core of our business. And then we have a brand called Dacia that is offering, value for money products. And it's really, a brand that is very adapted to the times. So we are seeing growth on both, on the three brands actually. But Dacia is somehow our life insurance to this kind of, potential demix. But I have to say that Renault, because of the new product coming in, will show a growth very, 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 very soon. Not only on the financial dimension, but also in the volumes in the next month. So I think we might be anti-cyclical because we will benefit of a very positive life cycle from now to 2025.
All right, Luca, speaking of your plans, you are planning to transform Renault and carve out EV and fossil fuel businesses. I know those plans are still in the works, but you've said it could include partners. Who are you talking to?
Now, we're talking to a lot of people, and we are looking at people not only on the automotive industry, but also from the tech industry, because we believe into such kind of horizontal partnership, horizontal to the sectors. So some of the challenges that we have in digitalization or energy transition are issues that cut industry horizontally. So I don't think we only have to look into our sector, but a little bit everywhere. And it's very exciting, actually. Hundreds of people are working on those projects. We don't only have the idea of, kind of separating a pure EV next generation OEM. We have other ideas, but we're going to talk about that in the fall.
What role will Nissan play?
We've been very transparent to our partners, so they know that we have to do it. That they know that we will do it, and we have opened the door to them for each one of the projects. But at the end, it's their decision if they want to jump on the boat. But the train is leaving the station. So
how is your relationship then with Nissan right now?
Very good. I have a very good relation with the management of Nissan and Mitsubishi. We're doing a lot of things. You will see very, very soon that we're taking the topic from the bottom. That means from concrete industrial projects. We already made a couple of decisions that are visible, like the cooperation with Mitsubishi on the lineup in Europe, or the fact that Nissan will be building successor of a small car in our plant on our platform. These are very, very concrete and symbolic signs that the alliance is getting into a new chapter, and that we are creating together a new dynamic based on fairness, respect, and win-win mindset, I would say. So I'm very happy. Very happy about that.
All right, Luca, thanks so much for joining us. Really appreciate your time today. Luca De Meo there is the CEO of Renault talking about the company's results. So, Kaylee, it looks like margins are improving, and the dream of coming to America, the door is still open to that.
Yeah, very inspirational. And speaking of margins, they held up pretty well for the likes of Apple as well. Both Apple and Amazon beating expectations after the bell. We're going to talk to a shareholder, Mark Stokel of Adams Funds, will be joining us next. This is Bloomberg.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Traders focus on recession instead of inflation. That's led global bonds to their biggest monthly gain since 2020. Today, investors are waiting for more data on the Fed's preferred inflation gauge, PCE deflator, U.S. personal income, and consumer sentiment. Big tech comes to the rescue. Amazon and Apple surprise Wall Street with quarterly sales results. We'll get analysis on that shortly. And Joe Biden and Xi Jinping now plan to meet in person, but the question of whether House Speaker Nancy Pelosi will visit Taiwan could complicate matters. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Matt, lots of earnings stories, moving markets around here in Europe. The data also of interest, but tech earnings, I suppose, that have been through the overnight session, I guess, for you guys, have been propelling NASDAQ futures.
Yeah, that's right. You had surprise positive GDP. Meanwhile, here in the U.S., GDP contracted by almost 1%. Nonetheless, earnings have surprised to the upside. And as a result, we have futures that are rising again after a couple of days of really strong gains. So S&P futures up 0.7%. We could see S&P 4100 today. The 10-year yield coming back up as investors sell some of those bonds that they bought to guard against the possibility of a recession. Right now, the level 2.7066. And as concerns about a recession are maybe allayed a bit, certainly in Europe, not as much here in the U.S. We have crude coming up, $2.20. This is for Text Intermediate to 98.62, but of course Brent is rising as well. Finally, Bitcoin not doing a lot, but hovering around a relatively high level of almost $24,000. So Bitcoin has had a good run with other risk assets. Of course, they're very positively correlated. Kaylee, what do you see in terms of pre-market movers?
Well, as you and Anna were saying, it really is all driven by two companies in particular, Apple and Amazon, because they're 10% of the S&P 500. They're almost 20% of the NASDAQ 100. So the fact that they are moving higher after the results really is what is leading the broader market here. Amazon is flying up more than 12% after it beat on expectations and gave a stronger revenue forecast than expected. AWS still doing well. And maybe that slowdown in consumer spending we were all worried about isn't hitting them too hard yet. But that big jump shows you how the bar was relatively low going into the quarter. Apple also higher by the better part of 3%, working through China's supply chain issues. The iPhone is still doing well, even as Tim Cook still recognized those macro headwinds, but it's getting a lift. Intel, though, a very different story, giving a disappointing outlook, cutting its profit and revenue forecast. It's dealing with competition as well as that economic slowdown. It's down 9%. And because of that economic slowdown, advertisers are spending less. We've heard that from Meta, we've heard that from Snap and Twitter, and we heard it from Roku last night, which is the TV streaming company. It is down 25% after its revenue forecast disappointed, Anna.
Kaylee, let's have a look at how we're doing here in Europe. And stocks are higher here in Europe. It's pretty broad-based across the European space, but in particular, the periphery doing pretty well. We saw that actually reflected in the GDP beats. They came through most strongly in Italy and in Spain. A less positive story in Germany, but it's also the earnings news that's pushing markets around today. Brent crude, just like Matt talked about with the WTI price, moving higher today, up by more than 2%. But onto the earnings stories, we've got NatWest, the banking group here in the UK, actually releasing some of the reserves it had for bad debts, and the market had been expecting those to build a little, so that's a better sign on the UK economy from NatWest. Renault, we spoke to the boss just a moment ago. That stock up by 3.6%. Yes, they took that took a hit really with regards to pulling out of the Russian business, but there was some guidance that was more positive, and the stock moving higher on that. L'Oreal up by 2.8%. This business, the CEO told me, Kaylee, protected by its geographical spread when times got tough over in China, but also in the makeup of its products from the lower end for consumers at that end of the market, but also up to the luxury end, and it's that breadth that seems to be supporting the business at this time.
All right, Anna, well, let's bring it back to the U.S. earnings story, because Amazon and Apple are set to add almost $230 billion in market value after joining Alphabet and Microsoft in assuaging concerns with higher revenue. Joining us now is Mark Stokel, CEO of Adams Funds. Mark's top holdings include Apple and Amazon, as well as Alphabet, Meta, and Microsoft. So basically all of the large cap technology stocks. Mark is up early for us on the East Coast. So Mark, obviously, you have positions in these companies. Judging by the market reaction, investors are relieved. How confident are you feeling, given that the beats weren't that large?
Well, it's a really good question. I think that the setup. I mean, everybody was scared to death coming into this week. You heard it everywhere, and the expectations certainly were lowered, I think. But looking at companies like Amazon, exceeded, even lowered expectations, but really good quarter. And Apple was really, really very good. So, I think we need to take into consideration the fact that all of these companies are working in an economic environment that is very difficult. And I think in a very difficult environment, I think tech earnings this week ended up much better than most people expected.
Well, to the point on the environment being difficult, in theory, as central banks continue to tighten, the environment could get even more difficult. So as Tim Cook doesn't give any, or Apple doesn't get any firm guidance, and Tim Cook talks about these macro headwinds, are you worried that even if they held it together in this past quarter, it's going to get worse as we move through the year and into 2023?
Well, I think you have to consider that. There's no question about that. To think that this quarter is the all clear from how the macro headwinds are going, if we continue to have headwinds, how they're going to affect these companies would be silly. So I do think you need to consider that. On the other side of that, I think you have to understand, or at least acknowledge the fact that Tim Cook and Apple have managed this better than probably any other company. So are there likely going to be some more headwinds? Likely, yes. And as a matter of fact, even Amazon talked about feeling their expectation that there would be a little bit more on the inflation front for them in the third quarter. So I think you have to do that. I also have to think you have to expect that in addition to the fact that these companies could likely have some more headwinds, they're really operating very, very well. And if you want to be invested, what is your alternative? I would say that investors should be invested in stocks like this for tough times. You see a Roku and what happened to them. You see Walmart, what happened to them from execution. Because of that, there were a lot of expectations that these companies were going to deliver, and they did. But you do have to be somewhat concerned about what's coming up in the next quarter, certainly for the balance of this year.
Mark, how do you feel about valuations? Right now, I think Apple has a forward PE of 25 and change. Does that seem attractive to you?
From a valuation standpoint, no. But I would also tell you and your viewers that valuation isn't always a good indicator of whether a stock is going to outperform or not. What is a really good indicator, frankly, is what Apple did this quarter. The fact that they delivered really good results. Is it expensive? Yes. I don't think there's any way, Matt, that you could say it's not expensive. So I think you need to balance a very good company delivering really good results with a higher valuation. I would put my money, until proven otherwise, I would put my money on Tim Cook before I would at Roku or some of these other companies that really haven't delivered very well from an operating basis.
Is there anything out there, though, Mark, that you feel is cheap right now? You know, for bargain hunters looking for value, where would you recommend?
Well, I will tell you, the intoxicating part of Meta is the fact that it's cheap. It's a really hard one, I think. You know, there are a lot of things that that are very attractive about Meta. My fear is maybe with biggest is the fact that it's really cheap. You know, they're going through they're going through a change. I mean, until last quarter, Meta had a halo over them. Of course, they disappointed in a very big way. But there are a lot of moving parts going on in Meta. I think for someone who has a longer time horizon, has a couple-year time horizon, could Meta be a good opportunity? Yeah, it could, because it is cheap. But I'm afraid for the next couple of quarters, it may likely be cheap for a good reason.
Okay, and there's a lot of change in management coming as well, Mark. Let me ask you about Amazon in a bit more detail. Advertising, something that, unlike for some tech names, advertising seemingly doing pretty well for Amazon. I read one Bloomberg opinion piece today saying we need more clarity on what exactly is driving that advertising number. Was that one area of strength for you?
It was a very big. Not only was it an area of strength, as you noted, it really flies in the face of what Walmart, what Meta, what Google, what Target, all of these other companies talked about, certainly for the consumer, but also for advertising. Really amazing from an advertising revenue perspective. So, but we do need to get that. They did not give us very much. I talked to Dave Schimminger, our discretionary analyst, about this for Amazon, and we really don't know exactly why it is. I mean, one of the things that they talk about is as customers are going through, as the consumer is going through Amazon and they're seeing their ads, they actually do have their credit cards out, and actually finishing that sale is a little easier for them than putting it on Instagram or putting it on Facebook and then hoping that the consumer moves to to buy something that they've looked at. So they're a little closer to the consumer from that perspective, but we really do need to get more input, because it just flies in the face of everything that everybody else reported.
Okay, thanks so much, Mark. Really good to speak to you. Adam Spun's Mark Stokel with us to analyse the tech sector. Coming up later, we'll go from tech to oil. Amrita Sen joins us, Director of Research at Energy Aspects. Oil prices back to their gaining ways this morning. This is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife. Come here, let me show y'all something.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Well, let's take a look at oil because it's heading for its first weekly gain in 4 weeks, despite concerns of an economic slowdown. WTI prices up 2.3% this morning to over $98 a barrel, $98.67 where we trade at the moment. Amrita Sen, Director of Research at Energy Aspects, joins us now. Amrita, I've got to be honest, a day after we saw a second consecutive quarter of negative GDP prints here in the U.S., I wouldn't necessarily expect oil to be doing this well. What does the economic slowdown ultimately mean for the balance of demand and supply?
So I think there's a couple of things, right? There is what we would call a technical recession, which is what the U.S. is in right now with the second quarter GDP numbers that have come out. But in terms of oil demand, I mean, employment matters a lot more, and we are really not seeing the kind of oil demand declines that you would expect from a kind of deep recessionary environment. So I do think it's important to put the GDP declines in context for the oil market. I think that's the first thing. The second thing is that there still is a lot of pent-up savings and demand due to COVID, and we've talked about this before as well. Asia in particular still seeing very, very strong demand growth numbers out of there. So overall, I mean, we have already factored in some really steep declines in our European demand numbers and US demand numbers from Q4 onwards this year. But if anything, there's potential gas to oil switching because of very high gas prices that can actually lift demand higher. But even with the kind of European and US demand declines, we still have global demand growth at 900,000 barrels per day year on year next year.
So would you say then, for those who are not so focused on just the energy markets, Amrita, would you say that maybe more broadly in the market, recession fears seem a little overdone, given what you're seeing in the oil space?
Yes, I really think it will matter from sector to sector, right? And employment, and given how tight the labor market is right now, if employment is the biggest driver of oil demand, given it's kind of linked to transportation, that's the key factor and the key variable that markets really need to look at. Of course, is the economy slowing down? 100%, 1,000%, I would agree with that. But it doesn't mean that we are going into an 08-09 style recession. I do find, talking to traders in the market, they always tend to compare, there's an upcoming recession, it must be like 08-09. 08-09 was a credit crisis. It was very, very different. This is much more the usual, recession like we've seen in 2001 or in the early 90s. In those periods, oil demand has still continued to grow.
Okay, and so that's the demand side. Let's get to supply, I suppose. Amrita, what do you see being the next driver on the supply front? I know we've got meetings taking place next week.
Yeah, I mean, look, OPEC Plus are meeting on the 3rd of August. We are expecting a very small increase from the group, continuing with what they have done. Now, of course, technically speaking, they have already unwound all their cuts from April 2020, May 2020, I should say. But they are going to continue to add a little bit, given how tight the market is. The reality is very few of these countries even have spare capacity, right? So even if the headline number is we're going to add 400,000 across the group, the actual volume coming out to the market is half of that, right? So it is something where this is structurally a bullish market, where unless and until demand actually declines outright, there just isn't enough supply. I mean, July high-frequency data is showing declines in inventory of over 2 million barrels per day. That's with SPR still coming out of both US and Europe. So imagine when the SPR stops at the end of October. I think that's the thing the market is completely missing right now.
How about spare capacity in the U.S. and Canada? How much spare capacity is there in the Gulf and in the shales, Amrita?
Well, there isn't spare capacity in the same way as OPEC, right? OPEC chooses to hold spare capacity, which is always very expensive to maintain. And again, the market needs to give them credit for doing that, because that's why, or that's how they try to prevent a lot of volatility in the market. U.S. producers are pumping as much as they can. The biggest issue with U.S. producers is the lack of labor, lack of equipment, steel shortages, and of course there is capital discipline, right? But that's just this new structure of U.S. shale. Similarly in Canada, but the real shortages in oilfield services is something to watch out for. We are expecting U.S. production growth to pick up from August. So far, we haven't seen the kind of pickup we needed to see in the rig counts or the well completions to be confident that our forecasts are going to come true.
How would you expect the oil market to react to Russia pulling out of Ukraine, or some sort of culmination of that war? What would the oil market do?
Headline, if, and we are absolutely not expecting this, but if there were to be an end to the war, first and foremost, doesn't mean sanctions will get lifted anytime soon. So it really depends on how sanctions move after that. But keeping all of that aside, I really, really want to stress on the fact we were at $95 oil prices before the invasion. We've called for $100 oil prices from 23 onwards, well before. This was back in 2018, and we had expected Russia to continue growing. Russia is not the reason we are here today.
Amrita, thanks so much. Thanks for joining us. Amrita Sen of Energy Aspects, taking a look at oil markets. And stay with Bloomberg for coverage of Exxon and Chevron's earnings. They are due before the US Open. We'll bring you the latest news analysis and market reaction. This is Bloomberg.
The public seems to have lost interest in waiting around for self-driving cars. I rode in Google's self-driving car in 2011.
Wow.
And I'm still waiting to be able to buy or just ride a self-driving car on demand. Why is it taking so long?
I think in self-driving, first of all, the opportunity is so clear. The reach is so broad. We forgot that big things do start small. We all know how to drive, but we're driving amongst humans, and you have to deal with so many little scenarios. There are so many things that you've been learning about driving since birth, and codifying that using AI, sensors, and computers is turning out to be a lot harder. Last but not least, it's a safety-critical system. None of us should deploy until and unless we have closed-loop evidence that we're safe.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio.
Griffin is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now, a strong quarter from Standard Chartered's traders provided a boost to the emerging market-focused bank. That's despite fears that a slowing global economy could squeeze its lending business. CEO Bill Winters spoke to Bloomberg earlier today.
I think the inflation problem we've got is quite substantial and reasonably intractable. So I think the Fed's going to have to hit pretty hard. So I guess that means a terminal rate at 3.5 or maybe even 3 3/4 or 4%. Is that what it takes to tip the U.S. into recession? Yeah, I think so. Speaking candidly, but we hope for the best. And I think Europe obviously has the incremental burden of energy prices, and that's tough. The good news is China is probably still going to produce 4% plus growth this year, and then better into next year. The inflation problem is a little bit less acute in Asia. Those trade flows within the Asian region are very strong, and we think that Asia could be a little bit of an engine to pull the global economy back from the edge, while the U.S. and Europe are going through their cyclical downturn.
With that in mind, to deliver that engine of growth, do you see a much more significant policy divergence, Bill, between PBOC to Fed to ECB? Is that what stokes that engine?
No, I think I think what's stoking the engine is that Asia has been suppressed by COVID in a way that the West has not been for the past year or so, and Asia is coming out of that period of repression, and that is, so yeah. Of course, there will be interest rate policies that will be reflective of the domestic economic situation and the domestic inflation outlook. And as we sit here today, the growth outlook in Asia is on a cyclical upswing. Together with inflation, which is relatively contained. Now, that's not to say that an inflation in the West won't impact Asia. Of course it will. It will impact trade flows. It will impact FDI. And to the extent that the U.S. has to hike rates materially, it will keep the U.S. dollar strong. But on balance, we see a bit of asynchronization between the West and the East, which has two effects. One is it should help smooth through this economic cycle, at least on the margin. And two, it's pretty good for Standard Chartered Bank.
That was the CEO of Standard Chartered, Bill Winters, speaking to Bloomberg earlier. Now, speaking of earnings, we've had some really positive surprises, but I think, Anna, the surprise is just that there was a surprise. It's not beating by that much. In fact, if you take a look at EA Go, you can see a whole slew of earnings data, and you'll notice the chart in the lower left-hand corner. For those of you on radio, I'll describe it for you. It shows blue columns that represent the amount of surprise, the amount of the beat that earnings have seen over the previous quarters, and it just comes down to almost zero. For example, in technology, we've seen only a 0.02% beat on sales and only a 1.01% beat on earnings. So the surprise is that we didn't get analyst cuts as much into earnings and that the companies still overachieved, but they aren't really beating by that much.
Yeah, it's interesting. And also, I was just looking at what you were showing there. I wonder if you strip out energy, and certainly this applies to the European case. If you strip out energy, does that make things look a little bit worse? It's interesting looking at the European side. I pulled up on my screen, and I can see that the sales beat was bigger than in the US, but the earnings surprise is not as good as the sales surprise. And so that chimes in with what Bloomberg Intelligence was saying, that often businesses here in Europe manage to beat on sales, but then the costs are kind of getting in the way of them beating on the bottom line as well.
Yeah, and of course, we've seen a real difference in the GDP stories as well. Just at the top of our show, European GDP broke much higher than had been anticipated, and most countries beat, although Germany didn't, but still it's positive, whereas here we're looking at a contraction.
Yeah, absolutely. A contraction in the US for the second quarter, beating on growth in the Eurozone. What happens next quarter, though, I suppose, is still the question. Inflation at new highs in the Eurozone. This is Bloomberg.
I think we need to think differently about, being enough. I think, in number of different respects, I think, we're trying to either prove ourselves or do too much. I think we have to realize that, as Black people, despite what society says about us, despite, what happens, we are enough. And so I think going forward in that headspace, I think is really important.
I think the pandemic really highlighted the importance of financial literacy. And in that, it's so important to understand, okay, like how do we budget? How do we plan for, unforeseen circumstances and really make sure that we're prepared for these events in the future. And through Blackstone Capital, that's why we really place a big emphasis on financial literacy in all forms, budgeting, retirement, investing, etc.
What motivates you guys to do this?
I think it's honestly the impact that we've already seen. It's something that we just want to keep going because we've seen students come in, learn everything that we teach them, and get really successful jobs on Wall Street, really change their trajectory, their career path. And so if we can keep doing that for the next 100 years, that's something that's satisfying for me.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This economy has materially slowed down. We are not in the roaring 20s. We are not in the reflation trade.
What we're seeing is what you would expect. Financial conditions tightening, the economy slowing down.
Most importantly, inflation is coming in a lot slower than I've been expecting.
Inflation just remains too hot for them to think they're going to stop.
If there was a pivot, it was that meeting-to-meeting guidance forward viewpoint from Chair Powell.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow, together with Katie Lyons. TK is out of the building. Futures positive, 0.8%. Do you like that pause, Bramo? TK is out of the building, on vacation. For a long weekend. He might be back on Monday. What a rally we've seen in this equity market. 2 days of gains post-Fed. And Lisa, they've been big days of gains.
They've been the biggest gains for a post-Fed meeting in history. That's according to the data that Bloomberg collects. How do we parse this with reality? Does this sort of get supported by facts, or is this hopium on the heels of a lot of pessimism, on thin liquidity, on people unwinding shorts? And honestly, that's what I think people are parsing through right
Did you see what Michael Harner over at Bank of America said this morning?
Bearish.
Dove at first sight.
Yeah.
Dove at first sight. And he essentially says when you get to 4,200, it's a sell. It's too early to price in a Fed pivot.
I was looking yesterday at the rally that we've seen in the 2-year yield. The idea that yields have come in dramatically. People are basically saying that this Fed will not have to raise rates nearly as much as they did, say, 3 weeks ago. How does this parse with 9.1% inflation? How does this parse with an employment cost index coming out later today that could potentially show ongoing strength in the pace of wage gains? How do we get a sense of the Fed backing away from its rate tightening policies at a time when they're not even restrictive yet?
Do you want to do the recession debate now or later?
Later.
Save that for Washington.
Yeah.
You want to avoid that? You sick of that already?
I'm just sick of this. It's a dumb argument to be having. Whether we're in a recession or not a recession, a technical recession, not quite a recession. Okay, maybe it hasn't broadened out fully. The question is, are we on this trajectory into a great and a gradual weakening that ends up in some sort of recession at some point in the next 6 to 12 months? It is not whether the NBER is going to come out and qualify. Do you like this argument?
I just love that I know you rehearsed this.
I didn't.
You were just ready to go.
No,
you had this
I don't
rant
like this
ready
debate.
to go. I've got one ready to go. I'll share with you later. Amazon up by more than 11% this morning. It's absolutely flying. Katie Lyons looking at the earnings out of Apple and Amazon. If you love this market yesterday, you got a green light to keep on buying it from those two names.
Well, considering they both beat and they represent 10% of the S&P 500, so if they're moving higher, you can bet they're taking the broader market with them, John. What's interesting to me is, at least for Apple, the beats were by a pretty narrow margin. It isn't a quarter that they blew out of the water, so it goes to show you just how much concern there was out there about a deteriorating environment
for Amazon, as much as we talk about a potential weakening in the consumer, it doesn't seem like they are seeing it yet. Their revenue guidance was very strong.
And so is this performance this morning, up 12% in the pre-market. Let's whip through the price action, up 0.7% on the S&P. On the Nasdaq 100, up by more than 1 full percentage point. In the bond market, yields have been heading in one direction over the last month or so, south. This morning, just a little bit of a bounce, up 4 basis points, 271.56. Euro dollar, Lisa, we have got to talk about the data out of Europe. Record high Eurozone CPI, GDP strong elsewhere, Germany stagnating. This is getting harder and harder for this ECB.
And Germany really standing out, with other regions doing better than expected, Germany doing worse. And this really is the story. How much is this a natural gas story, an issue of what's going on with Russia and the Nord Stream 1 pipeline? How much is that really going to determine the future of the German economy, at least in the near term? Today, it's ECI Friday. We get the employment cost index for the second quarter at 8:30 a.m. We also get other data, including personal income, spending, and the PCE deflator for the month of June. I'm looking at how much we see an ongoing acceleration of the pace of wage gains, especially because right now the market believes, at least according to pricing, that the Fed is going to be able to back away. Call it a pivot, call it perhaps a dovish move, whatever you want to call it. That is what's being priced into the market. Will this come out hot, and all of a sudden will people be forced to rethink that? At 10 a.m. we get the July University of Michigan sentiment data. We've been talking about inflation expectations over the next 5 to 10 years. That did soften recently in some of the recent readings, which is possibly why people have conviction to say that the Fed could back away. How much do we see it, though, continue to weaken? How much do people see all of the headlines about recession, whether it's a technical or otherwise? How much do people see the prices that they're paying and continue to feel negative about the outlook? Or do we see a rebound? And then how does the Fed respond to that? It's just a real messy soup of data, as well as understanding of what's coming ahead. And the earnings parade does continue. Oil majors Chevron and Exxon should be reporting within the next minutes, really. They could report any time before the bell. And I'm curious about Colgate, Palmolive, and Procter & Gamble, the consumer staples. How much are people going into those and moving away from discretionary items? It's really been a motley picture, at least so far. The takeaway for me, as we get the best monthly gain right now in the S&P, if things stay on track, going back to November 2020, John, is that people had priced in so much worse than we're getting that even misses are getting rewarded. People are cheering a bar that has been lowered and then a company stepping across, and I think about Apple. This is not exactly an incredibly strong earnings picture. It is just traders that have priced in so much worse, and that is what we're seeing, and I think that that's going to be the theme of this earnings season.
Amazon's a piece of that for sure.
Yes.
Up 12% in the pre-market. Bramo, thank you. Your day ahead, looking out for that data at 8:30 Eastern time, then again a little bit later this morning. Let's get to the conversation now with Tony Crescenzi, market strategist, portfolio manager, and member of the investment committee over at PIMCO. Tony, great to have you with us. How rare is it to have consecutive quarters of really strong nominal GDP growth and contractionary real GDP? And how on earth is the Fed meant to respond to that?
Well, the Federal Reserve, like investors, should recognize that there's been a lot of ups and downs in the economy in this quite fast-moving cycle since 2020. It was only last year we were looking at GDP numbers on a year-over-year basis in the double digits. And so we probably should be looking at it in that context. And the Federal Reserve probably is too. It is in the sense that it recognizes that the initial conditions going into this recession, if it is one, as Lisa suggests, we shouldn't obsess over whether there's a recession. We should be thinking about, as investors, what the depth of it might be if there is one. But the initial conditions going into this weaker year, as we could certainly call it, given the two negative GDP prints, is quite strong in lots of areas. And it suggests that the economy can handle a strong negative conditions, and so a strong storm, if you will. And so it's likely that the economy fares better than many expect when we are in a recession, if we can realize it when we're in it or in its aftermath.
Tony, this is the reason why I don't understand the market's reaction to the recent data and to the Fed meeting. Because if the economy does have underlying resilience, which seems to be the response, at least in markets, to some of these earnings, then why are people pricing in a Fed pivot? Why are they pricing that the Fed won't go as far, won't stay there for as long, and will start cutting rates as soon as the first quarter of next year?
It probably is a recency bias and reflects the experience of the 2010s and this idea that the Federal Reserve and other central banks can't go very far with their policy rate. We agree with the idea of a new neutral, the view we established in 2014, that the neutral policy rate today is probably lower than it has been historically. But it is what I think investors therefore are missing, and this is why yields today probably, you could say, are at the lower end of their new range, and that range probably is 2.5%, 3.5%. What they're missing is the 1970s experience and the degree to which Fed Chair Powell respects it. So, for example, real quickly, Arthur Burns from 70 to 78, then G. William Miller from 78 to 79, when the inflation rate would decline, it's still a positive inflation rate, when there was some disinflation from the very high levels that existed then, they let the policy rate decline too. In other words, they let the real Fed funds rate move downward or stay the same, whereas Paul Volcker, when the inflation rate started to decline, kept the policy rate up because he knew, as Chair Powell probably does, and certainly most likely does, that inflation expectations were the key. And the final ingredient to this, Lisa, is that we have new legions of people in the public that believe that the inflation rate could accelerate. And so the Federal Reserve need be conscious of that. So in other words, only boomers like me thought the inflation rate could accelerate before this recent episode. Now today, millennials, Gen X, Y, Z, all are believers in the idea of faster inflation. So therefore, the Federal Reserve in 2023 ought to be, and probably will be, cautious about cutting the policy rate and declaring victory on inflation when it moves down, and will be a little Volcker-esque in that sense and let the real Fed funds rate increase as the inflation rate comes down.
Tony, just quickly, Lisa mentioned that it's the best month for the S&P 500 going back to November of 2020. It is also the best month for global bonds going back to November of 2020. How long can they keep moving in the same direction?
Well, Kelly, as I mentioned, if you think of the valuation metrics and the possibility of recession and things of that sort, perhaps for the bond market, yields are moving toward the lower end of the range. So in the three components for a bond's yield, the term premium, the neutral policy rate, or where the policy rate should be relative to the inflation rate, and inflation itself, you come up with the math. Most equations back of the envelope, or more sophisticated, seems to suggest a range ahead of 2.5%, 3.5%. What markets seem to be doing to some extent, at least in the bond market, is entertaining the idea that Fed can't go far. It's an idea it should have thought of up anyway, and it's probably simply settling into a range. For the equity market, some of it, of course, reflects the optimism that might be building, not just toward the idea that the policy rate may not have to go as high as some feared, but that the economy is stronger, at least its foundation is stronger than many thought. And there are lots of reasons to think that, ranging from the household sector's balance sheet, the housing sector, and the skinniness of inventories relative to history. Same for automobiles, the extremely strong banking sector, and the need for investments in defense and supply chains and the green transition. So lots of good things out there that investors are starting to think about. And again, for bonds, I think it's a reinforcement of confidence in the Fed, and the Fed has regained control of the inflation narrative, and the markets are benefiting. You could say broadly, the final words, at least Kaylee, is benefiting from the Fed's tough love.
This is way too constructive for 6:11 in the morning, Tony. I don't know where this has come from. Tony Crescenzi of PIMCO there. Tony, good to catch up, buddy, as always. With Kenny Lyons and Lisa Abramovich, I'm Jonathan Ferro. Your equity market with a lift, piling into equities over the last couple of days post-Fed. We're up 0.8% on the S&P, up more than 1% on the NASDAQ. This from Credit Suisse and Jonathan Golub. Whether or not we're in a recession will be debated by academics. Today's report unequivocally reflects a substantial weakening in economic activity, raises the likelihood of a dovish pivot by the Fed, and guess what? Quote, for now, bad news represents good news for stocks. More still to come. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The euro area economy has expanded by more than 3 times the amount economists expected. That comes at a time when inflation and a possible Russian energy cutoff threaten to send the region into recession. GDP rose 0.7% in the second quarter, but inflation set an all-time high, up 8.9% in July from a year ago. Now, President Joe Biden and his Chinese counterpart Xi Jinping have told aides to plan an in-person meeting. That is according to a U.S. official. The two
spoke on the phone for more than 2 hours yesterday. That call centered on Taiwan, a long-time flashpoint. Matters could get worse if House Speaker Nancy Pelosi visits the island on a trip to Asia. That does begin today. Beijing is warning of a firm response if that does happen. The Biden administration has approved the sale of $8.4 billion in weapons to Germany. The package includes F-35 fighter planes and new air-launched cruise missiles. The State Department announcement made no mention of the war in Ukraine, but it did say the sale would support a NATO ally that is an important force of stability in Europe. And Apple has offered just enough good news to buy itself some time. The company's quarterly revenue and profit narrowly beat estimates, and iPhone sales held up better than expected. The CEO, Tim Cook, told Bloomberg TV that Apple is dealing with a slower economy, but he expects revenue to pick up again in the coming months. I'm Leanne Gerrans. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio. In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Earnings season is here.
Buzzwords this earnings season: recession, inflation, foreign exchange, layoffs.
We are starting to see, well, the world get a little bit more cautious about what these earnings are going to look like.
Bloomberg breaks the numbers first.
Second quarter earnings at Delta Airlines missed expectations.
When that inflation print hit, my eyes were on Amazon in particular.
With exclusive expert analysis.
The issue here really is elevated costs.
If you take a look at the projections, that is the story.
Bloomberg Television and Radio, the fastest numbers and analysis you trust.
We know there are challenges ahead of us. Growth is slowing globally. Inflation remains unacceptably high, and it's this administration's top priority to bring it down.
Janet Yellen there, the US Treasury Secretary, rolled out after that negative GDP print yesterday. The recession debate yesterday was tedious, wasn't it? Bramo, my goodness, it went on all day.
Okay, so I've been waiting for it. What's your rant?
My rant is that if you ask a Republican, they'll tell you it's a recession. A Democrat, they'll tell you it won't. You ask Main Street, they'll tell you it sure feels like one. You ask Wall Street, good news is bad news. And you ask an academic, ultimately, NBER is our master. I put that out on Twitter yesterday. The whole thing drove me nuts. In the UK, this was really simple. 2 consecutive quarters, negative growth, done. Over. We call it a recession. Then you get to turn around and say, yes, it is a recession, but ultimately there are some underlying points of strength here and we can talk about them. But it's become so politicized over here in the United States. And for certain people, they'll say, yeah, NBER. They say it's not just about depth and duration, it's about diffusion. Look at the labor market, look at the labor market. I'm with you. Ultimately, things aren't in a great place and they're getting worse, they're not getting better. And for a market participant, that is what you're focused on, right?
Cheers. That's all I can say. I think we're in complete agreement. It was just it was a frustrating exercise because I felt like everyone was talking over the real issues that needed to be debated.
If you're in this market, you're trading on what the NBER might tell you in months to come. I've got some IMF forecast to sell you, if that's what you're into. Futures on the S&P up 0.7%. On the Nasdaq 100 up by more than 1%. Typically, when you make a lot of money in tough times, you may be a little quiet about it. Katie Lights, the energy players are not quiet about this at all.
Yeah, speaking of things getting politicized, John, just take a look at big oil. We know that they're raking in profits. We didn't know that they were raking in this much. Analysts only expected Chevron to have earnings of about $4.96 a share. It came in at $5.82 a share. That is a record, and Chevron is returning more capital to shareholders with a $15 billion buyback. But Mike Wirth, the CEO, seems to know how that would play with the Biden administration. In the statement, he kind of pushed back on the idea of profiteering or prioritizing shareholders over consumers, saying, we more than doubled investment compared to last year to grow both traditional and new business lines. Chevron is increasing energy supplies to help meet the challenges facing global markets. So they're helping consumers too, John? Question mark?
That's not going to be in the government's communications, that's for sure. Lisa, they're going to lead with a $15 billion share repurchase program.
I mean, that's what all of these companies are doing. That's what we saw yesterday from Shell. They're putting their money back and they're not investing it in production because why should they if they don't have a clear backdrop on what the outlook will be like, what the regulatory backdrop will be for producing more in a year, in 2 years.
Emily Wilkins down in D.C., ready to react to this, our Bloomberg government reporter. Emily, how do you think the White House responds to a $15 billion share buyback program from Chevron?
I mean, one thing that you've seen the White House and you've seen Democrats kind of as a whole say is they've really put the blame for some of these high gas prices that we're seeing on oil companies, saying, look at the profits they are turning right now. Some of that needs to be passed along to the consumers. And that's really been the line that Democrats have stuck to, even as you've heard Republicans say that it's actually the Biden administration and their regulations that are causing really high gas prices right now. I think to a certain extent, even though you've heard Secretary Pete Buttigieg, other White House folks come out and point to the fact that gas prices have been falling, they still know that this is way higher than most Americans were dealing with, even with last year, and that it is still a concern going into the November election.
How much is that the reason why, Emily, in the recent bill that possibly they will pass, having to do with targeting cleaner energy and investing in some of the production there, how much are they looking for that to offset demand in some sort of real way in the near term versus just being an agenda point that was there before the pandemic and now has a reason to accelerate?
I think there's a little bit of both in what you're seeing with this overall package that includes $369 billion for various climate initiatives, everything from research and development to funding to help folks purchase electric vehicles, trying to incentivize that. One of the things you are going to hear Democrats make the argument on in this bill is that this is really going to help with energy security for the U.S. by trying to look at some of these cleaner energy alternatives, make the U.S. less reliable on foreign oil and foreign gas. So expect that to be one of the big talking points that you're going to hear from the White House as they try and sell this bill, assuming, of course, that everyone's on board with it. We still don't know if Senator Kyrsten Sinema is a yes. There were some concerns that she had about that carried interest loophole that gets killed in this current version of the bill, but the Senator Sinema really supports it, and that could lead her to be a no. If that's the case, this legislation is probably not going to go anywhere.
Well, and of course, on the subject of clean energy spending, it also includes permitting for drilling on federal lands, which is how Joe Manchin probably got on board with it in the first place. So we have to keep in mind that both things are happening here. So if Kyrsten Sinema is on board, there's likely no path to reconciliation. What about the other legislation that they're still currently working on?
So reconciliation is really the big package that they are trying to work on right now. Lawmakers say that they are still reviewing the bill. It's more than 700 pages long. They want to take a close look at this. I think the biggest concern, though, at least from Manchin and from a number of other more moderate, fiscally conservative Democrats, is will this impact inflation? And they've heard from folks like Larry Summers, who has been openly critical of the Biden administration, that this package will not, that the taxes that they are putting in place will offset the spending that they are doing, that it will decrease demand, that it will increase supply, and that the bill will ultimately be a good thing. So that's what Democrats are really banking on right now, that this won't be impacting those higher inflation numbers, and in fact might actually wind up helping Americans if they can pass certain things like reducing the price of drugs. That might actually put more money in Americans' pocketbooks. Of course, Republicans are raising the red flag right now about the fact that this could impact inflation, tying it back, of course, to other major bills that Democrats have passed during Joe Biden's presidency.
Emily, thank you. Emily Wilkins down in D.C. We'll catch up on that China call in the next hour. Bramo, I love that Larry Summers is now a source of reference for this administration when it comes to this bill. But the whole of last year, we don't want to talk about what he's got to say.
Maybe they're trying to say he's got more credibility because he basically, I don't know, what's the correct way of saying it? Basically eviscerated their previous spending plan and said that that was the reason why it caused the inflation that we're seeing now. They're now using him as saying, look, even he supports us, and he was perhaps really, against us earlier.
Politics drives me nuts. It just drives me insane. Should we talk about that call between the U.S. leader and the Chinese president? 2 hours and 20 minutes. How do you think this went when she turned around and said, whoever plays with fire will get burnt?
He said that before. This is his line that he uses on Taiwan. What I found really interesting is that nobody said that it was a constructive call. In the past, everyone always talked about how it was a constructive call on either side, on both sides. Nobody said it this time. And not only that, but in 2 hours and 20 minutes, they agreed on meeting potentially in person. In person,
yeah.
But there was nothing else conclusive that came out of that.
Is this a passionate, loose exchange where he says, play with fire, get burnt, or do you just kind of read it slowly and just make sure that you put that quote out there, and then the next guy reads his statement, and then the other guy reads a statement, and you just happen to do that over a call?
John Farrow, the screenwriter.
Play with fire, get burnt. This is Bloomberg.
This week on Bloomberg Green, the green energy of the future, how to make clean hydrogen and its benefits for the planet. Flying high, we take a look at the practical uses of green hydrogen as jet fuel.
To hydrogen fuel cell being the best approach from the cost of fuel, efficiency of utilization of the fuel, and the mitigation of the climate effects.
And from a small part of the energy picture to making it available for all. We talk the challenges and opportunities in widening access to green hydrogen.
My biggest dream is to see green hydrogen become mainstream, actually, and not just to have these little pockets of applications or these demos, but for it to really become the fuel of the future.
From Bloomberg's world headquarters in New York, I'm Kaylee Glines, and don't miss the latest edition of Bloomberg Green, airing this weekend on TV, Quick Take, and online.
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
When it comes to the earnings, so far so good. That's the story this morning. Good morning. It was the story yesterday afternoon, whether it was Apple or Amazon this morning, whether it's Chevron or Exxon. Another upside surprise from Exxon just moments ago. Futures up by 0.75% on the S&P, on the Nasdaq up by more than 1 full percentage point, supported by a really strong rally from the likes of Amazon and Apple with a decent gain as well. The last 2 days up by almost 3.9% on the S&P 500. Really powerful 2 days of gains. The why? Jonathan Golliver, Credit Suisse, said it. When it comes to the economic data, it's a bad news, it's good news story for this market. I hate that. And we're going to talk more about it in a moment. Did that sound sinister enough for you, Bramo? Yeah. In the bond market, 2s, 10s and 30s look like that. On a 2-year yield, yesterday we came in about 13 basis points. That's fading the Fed story this morning. A small bounce, up a basis point or so, to 287.84 on a 2-year. In Europe, stuck between a rock and a hard place, that is Germany and this ECB right now. German growth stagnated. You had some strength elsewhere, but that's problematic. How does this ECB respond to it? With CPI that far away from a 9 handle in Europe, and some people don't think we've seen the highs just yet. Euro dollar just about positive at 102.14, positive 0.2%. Equities in Europe gaining on the stock 600 by 0.8%. And I have to say, Lisa, Goldman, Sharon Bell out this morning saying she can smell the complacency from miles away, and they do not like this market, at least right now.
A lot of people have been talking about complacency, and thank you, John. Honestly, we're still seeing that rally continue, and we're still seeing a lot of short positions come out, and we are poised for the biggest rally going back to November 2020 in the S&P. Some people who last year were talking about how there was a faulty call in transitory were included among them Barbara Ann Bernard. She came out and she was saying this is not the case. It's stickier. It's more protracted. You need to plan as such. She is founder. She is chief executive officer and Chief Investment Officer of Windcrest Capital, joining us right now from the Bahamas. Barbara Ann, can you just talk about what you make of this rally that we've seen so far in July, which might be the biggest going back to November of 2020?
Thanks for the opportunity, Lisa. Yeah, I think this is a bear market rally for sure, and it's based on hope, not on free cash flow. Not on the free cash flow of the consumer and not on the free cash flow of the corporate. When you have, what we're looking at is negative real wage growth, which is why we have the lowest consumer confidence in 40 years. And what businesses are facing is the highest PPI rates in 45 years, which is why small business confidence is at an all-time low. So these businesses are facing very little visibility over demand for their goods and the cost to produce them, which is not a healthy situation. And meanwhile, the market is rallying on, like we said, hope, not free cash flow. So I don't think it's sustainable, unfortunately.
Barbara Ann, let's go to the phrase that John Farrow hates the most, which is bad news is good news, which is what Jonathan Golub was talking about in his note today. That's what it's become. That the more people start to talk pessimistically the way that you do, they talk about possibly some sort of pivot from the Fed. Why is this not the right way to look at it, since it has been the right way to look at it for the past few decades?
Well, let's just break that down. Is bad news ever really good news? What you're talking about is the Fed will not raise rates. So we're talking about multiple expansion, not EPS expansion. And a healthy economy is based on EPS expansion. So yes, you don't want to fight the Fed, but we also want a healthy economy, don't we?
Well, in theory, Barbara Ann, yeah, I would assume so. But on the subject of the Fed and how they would likely view what we have seen in the equity market, a rally, financial conditions getting easier and not tighter, at what point will they have to push back on this?
Well, I feel like they induced this rally. It was the most confusing. Either I was on the wrong call or I misunderstood the market. But what I heard was there's no more guidance because we're tired of being wrong. And then number one, our goal is to bring down inflation for a soft landing. But number two, we understand that's challenging, and it's got more challenging in the recent months. None of that's positive to me. And then I think the real error was calling 2.25 to 2.5 a neutral rate. In my economics textbooks, that's not the case, particularly not when inflation's at 9%. So that is very stimulative and accommodative, and that's what's fueling these forces that at the same time he's trying to squash. So he also said the dot plot is the best indicator. Well, what does the dot plot say? That we have 100 basis points of more increases this year and 50 next year. So rates are still rising, and we have consumer and business confidence falling. We've never raised rates into falling confidence. And the other really interesting experiment is we've never raised rates when the U.S. Fed debt to GDP ratios are so high. So if we do induce a recession, the real risk out there is now you have lower tax receipts and higher interest expense, which is also not a pretty picture. So this is not easy. And I think as an active manager, what you want to do is really stay nimble and humble, because we're now told we're going to focus on data, which is going to be much more volatile.
Well, of course, Chairman Powell said they need to be humble as well. As you're doing that, as you're being nimble and humble, what does that mean you want to buy? In the environment you're describing, which, as you say, we've never been in before, in theory, higher rates mean you don't necessarily want to be owning growth, and yet if the economy is slowing, maybe you want that cash flow. So what do you do?
It's a great question. So we actually are net short, and we have a mountain of cash to buy great opportunities when we see them. We don't think we're there yet. We have initiated two new long positions all year. And so the barrier to entry to get into our fund right now is so high. So what does an attractive opportunity look at? We're talking about companies that are trading for the cash on their balance sheet when we're getting the operating business for free. So that kind of upside downside skew is the margin of safety I'm willing to take. Otherwise, we've been generating tremendous alpha on the short side. I think we have 37 individual short positions. And this is a real stock picker's market. You would be very happy if you were long Amazon and not Walmart this week, right? That's a stock picker's choice. So being tethered to an index that I think has further downside is where I see the real risk.
Barbara Ann, do you see a lot more potholes like the ones that we have seen in specific names? And I'm thinking of some of the darlings of the pandemic era. Do you see more of that coming, or is this just an ongoing bleed that the short positions will capture?
No, absolutely. I mean, Lisa, if you think about this, in a rising rate environment, it's crushing a whole cohort of companies whose business model was built on free money. And so all of that speculative has to drain the swamp. And so you're looking at companies that are over-levered, are counting on free money, and they're really going to be in trouble. So we haven't seen the zombies fully deflate yet. And then you're also looking at companies in the pandemic era that took on a ton of debt. You just look at someone like Carnival Cruises, who just did $1 billion equity raise and still has 6 times net debt to EBITDA. And if you go by what Royal Caribbean said this week, demand's not there. That is a problem. So no, the shorts are very, very company specific. It's more company specific than a macro view, but this is a real source of alpha generation in a market like this.
This final point is so important. Not just Walmart versus Amazon, but Alphabet versus Facebook as well. Barbara Ann, fantastic to catch up with you. Barbara Ann Bernard there of Windcrest Capital. And Brahma, that's been the story of the week, hasn't it? If you looked at Walmart, retail's weak. You looked at Amazon, things are just about okay. Alphabet, things are all right, resilient company. Google doing all right on the ad revenue. Facebook, dreadful. Snap, even worse. The dispersion within those industry groups is pretty interesting.
Which raises a question of whether this is an execution issue or whether it's a consolidation of business issue, with the ones that are going to win, winning big, and those that are not actually losing even bigger and having their business cycle accelerated to the downside. How much is that really the story, John, of the bifurcated earnings rather than a wholesale weakening that portends something to come on a macro scale?
Well, given the weightings of Amazon and Apple in the NASDAQ, we're doing okay this morning. We're up 1% and some. Here's the quote of the morning so far from Barbara Ann. There's no more guidance, Kaylee, because they're always wrong.
Yeah, and they're tired of being wrong. She's essentially saying the equity market heard this entirely the wrong way, that what she heard from the chairman is that they are still going to be reacting heavily to inflation. And that is after an equity market that rallied 2 days, the best Fed rally, post-Fed rally we have ever seen. So it's interesting how you are having economists saying one thing, people like Barbara Ann saying one thing, and the market is feeling something entirely different, raising the question of, is this Fed pivot now that the market seems to be focused on, one that realistically is going to be coming when it thinks it will?
I wish there was a live feed of Lisa and I during the news conference with Chairman Powell, just watching this board of equities climb, and Lisa and I looking at each other with the mics off, throwing up our hands and going, what is going on? Another meeting with stocks rallying really hard, and is this an unintended, unwarranted loosening of financial conditions? And do you remember what Bill Dudley, Jeff Rosenberg both said? They were both pushing back hard.
They both were very nicely saying, we don't buy it and people are trading on hopium, and how much is this really going to lead the Fed to come out with even tighter guidance? That said, and just to be contrarian to myself, and I know that's head spinning, but I go to Gina Martin Adams, where she was talking about how this rally could be viewed as constructive, that we haven't gotten the best earnings and that a lot of these stocks still rally, that we know the bad news, stocks still rally. Is it hopium, or are people saying it's all priced in, and what are they pricing in? And the counter argument to that is, I just don't see how the Fed is going to loosen conditions as early as next year if inflation doesn't come down way more and well closer to 2%.
Well, rates climbed, didn't they? And that was poison for this equity market, and rates have dropped away. And that is seemingly bullish for this equity market. At some point, Lisa, you start to pivot and think about not rates are down, but why are rates down, and focus on that instead. And that's the point that Mike Wilson of Morgan Stanley's been trying to make for a long time. You've got Mike Wilson on the one side, and on the wrong side right now, and you've got Marko Kolanovic of JP Morgan on the other side, who's been on the wrong side all year, and he's on the right side right now, because Bramo, this is what he's been looking for.
I just really question whether that works this time around. How does the Fed loosen conditions? How do they back away from tightening conditions so quickly if we haven't gotten inflation down? If we have a 7 handle, if we have a 6 handle, if we have a 4 handle on CPI, how can the Fed go ahead and say, you know what, we're going to start cutting rates? They risk going back to the 1970s, experiencing what happened in 1974, and that specter looms large over this Fed.
Inflation has a 9 handle. Given the tone of the conversation this week, I think you could forget that sometimes.
I know.
Futures on the S&P up 0.8%. On the Nasdaq 100 up by 1.2%. The earnings good enough from some of the big tech players, helping out a massive week of gains. You roll in this dovish interpretation of this Fed, and we're off to the races for the bulls in this market this week. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. House Speaker Nancy Pelosi is set to leave on a trip for Asia today. The question is whether she still plans to stop in Taiwan. Reports that she is considering a visit there have drawn harsh criticism from China, which considers Taiwan to be part of its territory. Meanwhile, Taiwan was one of the central issues discussed in a phone call between President Biden and China's Xi Jinping yesterday. Biden warned Xi against military action to reunify Taiwan with the mainland. Bloomberg has learned that the Chinese government did ask TikTok if it could open a stealth propaganda account. The goal was to target Western audiences with content that showcased the best side of China. TikTok turned down the request and said it would have violated guidelines. TikTok is owned by Beijing-based ByteDance. It has tried to distance itself from Chinese government influence. Right here in the UK, Rishi Sunak has admitted he is the underdog in the race to be the next Prime Minister. future, but he is vowing to fight for every vote. While campaigning in Leeds, the former Chancellor admitted his pledge not to cut taxes until inflation is under control was not universally popular. Sunak's rival, the Foreign Secretary Liz Truss, has promised to cut taxes as soon as she takes office. And shares of Amazon jumped in early trading. The company showed its e-commerce and cloud computing business can churn out revenue even as customers worry about inflation. Amazon's second quarter sales beat estimates, and it gave a revenue forecast for as much as 17% growth in the current period, plus fulfillment expectors rose less than expected. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife. Come here, let me show y'all something.
We are
really not seeing oil demand declines that you would expect from a kind of deep recessionary environment. Even with the kind of European and US demand declines, we still have global demand growth at 900,000 barrels per day year on year next year.
And Rita Sen there, Energy Aspects Director of Research from New York. Good morning. Futures look like this, up 0.8% on the S&P, on the Nasdaq 100 up by a little more than 1 full percentage point. The energy names out this morning with earnings, Chevron and Exxon. Katie, Exxon
Hello,
about 3.
Day traders. Anybody who wants to trade Bitcoin, here is a chance. 24,081, the price I'm looking, 84, the price I'm looking to sell Bitcoin. I'm placing the order, so I'm placing it in order to sell Bitcoin contract at 24,084. If you're looking to trade Bitcoin, or if you're looking to copy my trade, please do so. Place the order to get filled, and then I'll speak to you after we will fill this order, and I'll let you know what we're going to do next. I'll speak to you later, guys.
Down as much as they have.
Just a group effort all round. Kumbaya.
Go team.
Yeah, right.
I mean,
please. Stephen Short's got things to say, the principal of the Short Group, and he's going to say those things right now. Stephen, talk to me about why gas prices are down over the last month.
Yeah, absolutely. When you tank the U.S. economy and you put the consumer up against the wall, they're going to respond. And demand for gasoline is well below normal at this point in the season. When we go ahead and we adjust, seasonally adjust where we expect demand to be, and when we do our analysis, of course, we're going to take out 2020 because when we had the severe demand destruction. So we're not even looking at those levels. But when we're looking at gasoline demand, that has been the driver right now in the pullback in prices. Unlike what Brian Deese, the White House spokesman, who claimed about a month ago that the SPR release was 100% responsible, solely responsible for the pullback in gasoline. I just don't get it. Back in June, gasoline prices peaked at over $5 a gallon. When you look at the last 46 Junes, prices were 60% higher than the real, i.e. inflation-adjusted average of the last 46 Junes. In July, even though we've had this pullback, prices are still 40% greater than the last 46 Julys. So yes, we've had a bit of a pullback. This is solely because of a pullback in demand here in the United States. And that said, we're still looking at much higher prices. And of course, this is beginning to transition into the earnings that we are now seeing reported by the big oil companies.
Stephen, there's a lot here and a lot to unpack. I want to hone in on one aspect of what you were saying, which is when you tank the economy, then you can get lower gas prices. I want to take issue with that because the earnings that we're getting, yeah, they might be weaker than in previous years in terms of the magnitude of beats, but they're still okay. And there is some constructive data out there. Do you think that this is as a result of what's going on with Fed policy and the weakening statistics, or is this just a logical demand side response to prices that were too high? Did we see where demand destruction kicks in?
Yeah, no, I'm certainly on the boat that this is demand-driven at this point. You know, a little bit of the change in the calculus that everyone has had to deal with now is the impact of substitutes into the market. This is something we've never had to factor in, and of course, I'm talking about EVs and hybrids. So that threshold, that pain point for Americans, where before it was about $3.60, $3.70 retail at the pump, this is the price point that we began to see demand destruction. Of course, that's risen over the years. You know, I personally, as an anecdote, I drive an electric hybrid. I get blended about 70 miles to the gallon. So I'm not as sensitive to price as I was 10 years ago. So that threshold has certainly moved higher. And clearly with gasoline prices now at above $5 a gallon, we are now starting to reap that benefit of the demand destruction. The consumer is responding. And let's keep in mind, we've also had substitutes, but the other thing that we're dealing with we never had, and this of course is COVID, the lag of COVID demand destruction. And what I mean by this is one of the reasons why gasoline was always the most inelastic as far as demand was concerned is because, one, we always had to drive to work, we always had to drive